right? Done day for yesterday. Yesterday, we properly started with the concept of banking. Now, what we have discussed in banking, we started with the types of money, different types of money, right? For example, we have discussed the concept of fiduciary money, commercial bank money, right? The third one is a fiat money, and the fourth one is a commodity money. And basic evolution is more than sufficient. Initially, we had barter system. Then we introduced the concept of commodity money, and from commodity money, we have shifted to fiat money, right? Currency, coins, currency, notes, etc. Apart from this, we have commercial bank money. What's a commercial bank money? It is basically a credit creation, a process of creation of credit, right? A credit creation process done by the banking sector. Now, basically, we have seen that the banks will keep part of the reserves. I repeat, the banks will keep part of the reserves with themselves, and apart from that reserve, other money will be used for lending purposes, right? And this credit creation process is called as a commercial bank money, and this is done through fractional reserve system. Then we have seen the structure of banks in India. What is the banking structure? At the top of the banking structure, we have Reserve Bank of India, which is the regulator of the bank, and we are still in RBI only. Right? So imagine to what extent RBI is important. We started with RBI yesterday, we are still in RBI. Right? So at the top of the tier, we have Reserve Bank of India. Under this, we have scheduled commercial banks and non-scheduled commercial banks. Scheduled commercial banks, example, public sector banks, private sector banks, regional rural banks, etc., etc. Right after that, we have discussed the evolution of Reserve Bank of India. RBI was established with the passage of RBI Act of 1934, and on the 1st of April 1935, we established RBI. After that, what is the composition of Reserve Bank of India? Central Board of Directors. Do you remember the composition? 1 plus 4 plus 10 plus 4 plus 1 plus 1. Central Board of Directors, 21 people. In addition to this, Central Board of Directors, we have regional offices. We have four offices at historically important places. Now, yesterday I was checking some of the comments of the students. There were students who were asking, sir, historically why Calcutta is important? Historically why Chennai is important? My dear, please go back to your high school. Right? Please go back and remember. Again, when I say please go back, not literally, right? Not literally. Right? Please go back and imagine where did the Britishers come? Where did they set up their right the forts, etc., etc., where they had their main places of business, organization, etc. Then you'll understand what is the importance of metropolitan cities in India. Then we have discussed certain sections of Reserve Bank of India Act, certain sections of RBI Act of 1934. For example, Section 3, Section 8, Section 21, right, Section 47, etc. Certain sections have given. Please remember them as per the requirement of current affairs. Then we entered into the functions of RBI. Functions of RBI. The first function of RBI is to control inflation. That we have discussed earlier. Please go through that. Second function is the printing and distribution of currency notes. Today we have Gandhi series notes 1996, and all these Gandhi series notes are printed by RBI except 1 rupee note. 1 rupee note is printed by Finance Ministry. Currency coins are minted by Government of India but distributed by Reserve Bank of India. Then another function is to act as a banker to Government of India. There's a tool called as Ways and Means Advances, under which Government of India can borrow from RBI for only short duration, 90 days. And what about the state governments? State governments are also allowed to borrow from RBI under the Ways and Means Advances, again for the same period, 90 days. Second one is RBI will help Government of India to borrow from the market. RBI will maintain the public debt of Government of India. What's a public debt? Public debt basically means it is the liability. It is the amount that has to be paid by Government of India. The debt can be divided into internal, external. Internal debt, mainly the government has an internal debt in the form of borrowings by issuing government securities. And yesterday we have discussed what type of government securities are there: treasury bills, dated securities, etc., etc. After that, we started with the concept of monetary policy tools. Idea of monetary policy tools. I said there are two types of monetary policy tools. That is, one is a quantitative, which is called as a general method, and the second one is qualitative tool, which is called as specific methods or specific set of tools. Now, in case of quantitative, yesterday we have discussed CRR, bank rate, SLR, repo and reverse repo, open market operation, and even standing deposit facility, as well as MSF, marginal standing facility, MSF. Now we are supposed to start with qualitative set of tools. Qualitative set of tools. Now before I go forward with the qualitative set of tools, please tell me, can I say that RBI can use repo and a reverse repo to adjust liquidity in the banking sector? Let me know. And by the way, the term liquidity here simply means the amount of money that is available for the bank to give loan. Very simple. If you ask me, sir, what do you mean by liquidity? Is the amount of money that is there with the reserve, that is there with the banking sector to provide in the form of loan. If RBI will change a reverse repo, if RBI will change a repo, don't you think the liquidity in the banking sector will change? Right? That is basically the concept here. And why I'm discussing all of this, there is a term, suddenly UPSC will use this. Do not be confused. Liquidity adjustment facility. Liquidity adjustment facility. LAF. Liquidity adjustment facility. Can I say the RBI, Reserve Bank of India, can use repo, reverse repo, STF, etc., right, to adjust liquidity in the market? Of course, yes, they can use it. So LAF can be used by UPSC. Please do not be confused. They are talking about these kind of tools using which we will adjust liquidity in the banking sector. Now let me start. Let me start with qualitative set of tools. Qualitative set of tools. Okay. Now, first one is the concept of rationing of credit. Under this, we'll discuss a concept of priority sector lending. Priority sector lending, PSL. First and foremost, please understand what do you mean by rationing of credit. Rationing means what? Anybody in the classroom? Let me know. What do you mean by rationing? Rationing simply means distribution. Rationing simply means distribution. Distribution of credit. Rationing of credit simply means distribution of credit. Now, generally, what happens is there are certain sectors which are very risky to provide loans to. I'll give a very simple example. Right, all of you will agree with me. There are certain sectors which are very risky to provide loans to. Loans to. For example, agriculture sector. Please tell me, agriculture sector, how many of you believe that it is very safer to provide loans in the agriculture sector? Is there anyone who says, sir, it is very safe to give loan in agriculture sector, let's say to farmers? Right? All of you should say, sir, no, it is not very safe. Why? Look at what is happening in India's economy today. You think the same situation will remain after 2 months? You think the prices of tomatoes will remain at 200 rupees after 4 months, after 5 months? The prices of agriculture commodities will remain elevated after 4 months? Of course, no. So there is so much of uncertainty, there is so much of volatility, unpredictability associated with agriculture sector. So generally, banks would not prefer to provide loans to some of the sectors. But can RBI allow this to happen? Can RBI simply say, then don't give loans to agriculture sector? Don't give loans for exporters. They can't do that. In order to protect, in order to address this issue itself, the Reserve Bank of India has introduced the concept of rationing of credit, under which there is a tool by the name of priority sector lending. What is a priority sector lending? Whenever the banks will provide loans in 1 year, whenever the banks will provide loans in a year, up to certain percentage of the loans, up to certain percentage of the loans, the banks will have to provide it to some of the sectors. Any difficulty? Up to certain percentage of the credit that they provide, they will have to provide for some of the sectors. For example, agriculture sector, educational loans, affordable housing, export credit, right? Startups, renewable energy, weaker sections of the society, etc. Totally 8 areas are covered under this. Totally 8 areas are covered under this. And the banks will have to ensure that in that year, whatever loans they have given, up to certain percentage, they will have to provide for these areas only. And this tool is called as priority sector lending, PSL. Now, there is a technical term I've written here. Many of the books have not written this, and most of the times, even experts will not use this. They will simply say percentage of credit. They will simply say percentage of credit, that is percentage of loans. But technically speaking, there's a term called as adjusted net bank credit, ANBC, adjusted net bank credit. Now, let me give a very simple example here. Imagine the bank wants to invest 100 crore rupees in the market this year. The bank wants to invest 100 crore rupee market in this year. Let's say out of this, 80 crore rupee they will provide in the form of loans, 80 crore in the form of loans, and another, right, let's say 20 crore rupee. Another 20 crore rupee they will invest in non-SLR bonds. Do you remember the concept of SLR? Let me know. Do you remember the concept of SLR? Yesterday itself we have discussed. Right? Anybody has a doubt regarding SLR? SLR is basically statutory liquidity ratio. Percentage of the NDTL that the banks will have to keep with themselves, either in the form of gold, in the form of a cash, or in the form of approved securities such as government securities. Now, apart from these government securities that is counted under SLR, the banks will be investing in other types of bonds as well. Is it okay? Apart from the government securities counted under SLR, the banks will be investing in other form of bonds as well. These are called as non-SLR bonds. These are basically referred to as non-SLR bonds. So have a look at this. Adjusted net bank credit simply means total value of the loans provided plus investment done in the non-SLR bonds. For example, for right, let's say public sector banks. For public sector banks, priority sector lending. Priority sector lending is a 40%. For public sector banks, priority sector lending is 40%, which means in 1 year, a public sector bank will provide loans of, let's say, 5,000 crore rupees. Out of that, 40% of the loans have to be given under PSL itself. For example, RRBs, regional rural banks, it is set up at 75%. For regional rural banks, the PSL is set up at 75%. For small finance banks, the PSL has been set up at 75%. What is the meaning of all of this? Whatever amount of loans that they provide, right, including non-SLR bonds, whatever amount of loans that they provide, out of this, right, understand this, 75% should be given to following sectors. That is basically the concept of rationing of credit. Now, out of all of this, whether it is 75, 40%, out of all of this, highest amount of loans are always given to agriculture sector. Remember this. Out of all of this, highest amount of loans are given to agriculture sector. These are certain points regarding rationing of credit. Now, think of this and please answer to me. Can RBI implement a policy where specifically using this tool, can they increase the loans only to agriculture sector? Let me know. Think of it. Think of it. Can RBI use only this policy, that is rationing of credit, priority sector lending? Can they increase, Arey Baba, can they increase the loans only to agriculture sector? Yes, my dear, they can do that. They can do that. I've already told you. Out of, let's say, public sector banks, out of loans, which are given by public sector banks, 40% will go to the areas under PSL. And right, and under that, understand the next point here. Out of the total loans given by PSBs, I said maximum amount of loans under PSL go to agriculture sector. How much? 18%. 18% of the loans given by the public sector banks should go to agriculture sector because of PSL criteria. Now, please tell me, what if RBI will increase this from 18% to 20%? What if RBI will increase this from 18% to 25%? Please have a look at this and tell me now. Can it target only agriculture sector now? Arey Baba, even after this, is there any doubt? I'm saying under PSL, 40% for all these sectors. 18% should go to agriculture sector. What if RBI changes this from 18% to 25%? What if RBI will change from 18% to 15%? Don't you think only in agriculture sector, either the loans given will start increasing or loans given will start decreasing? Hence, now can I simply say priority sector lending is a qualitative set of tool? Any problem now? Right? Qualitative set of tool, qualitative, not quantitative, qualitative. And if you remember yesterday, I've given an annotation, right? Annotation. In the annotation, I've written it. Quantitative, overall money supply in the economy will change. Qualitative, money supply will change, but we can target specific sectors. We can target specific sectors. So one is rationing of credit. Second one is regulation of consumer credit. Regulation of consumer credit. Now let's start with a very simple example. Imagine you want to take a car. Okay, imagine you want to take a car. Now, point number one. Let's say price of the car is 10 lakh rupees. Price of the car is 10 lakh rupees. Question number one. How many of you think that bank will give you a loan of 10 lakh rupees? Anybody is there in the classroom who says bank will give you the full loan of 10 lakh rupees? No, bank will not give you full loan of 10 lakh rupees. They will give you 70% of it, 60% of it, or 50% of it, whatever it is. Whatever the number is, don't worry. Let's say hypothetically, bank will give you 8 lakh rupees in the form of loan. Point number two. If the bank is giving you 8 lakh rupee loan, I hope you understand. Now they will say you will have to make a payment of, let's say, 40,000 rupees every month. Again, just hypothetical numbers here. Don't ask me about calculation. Let's say the bank will say every month you will have to pay 40,000 rupees and you will have to repay the loan. You will have to repay the loan in 3 years. Again, just hypothetical calculation. Don't ask me what is the rate of interest, etc., etc. Let's say bank will say every month you will have to pay 40,000 rupees. Now, this 40,000 rupees every month is referred to as equated monthly installment. This is referred to as equated monthly installment. EMI, equated monthly installment. Done, which means monthly, right? Monthly, you'll have to keep on paying 40,000 rupees for 3 years. Loan will be repaid. Now, simple question to all of you. Think of it and please answer. What if the bank will change this from 40,000 rupees to 25,000 rupees? Please tell me, will the vehicle loans issued by the bank change or not? Simple question. Will the vehicle loans issued by the bank change or not? Will the number of loans change issued by the bank? Will they change? Of course, yes, they will change. Some of you are saying, no, my dear, they will change. More loans will be issued now. Why? I'll tell you. Why? I'll tell you. Don't you think many of the people looking at the term 40,000, monthly 40,000 payment, they'll say, I cannot afford this amount of payment. Think of it, right? If you are asked to pay 40,000 rupees every month, many of the people will simply say, I want to purchase a car, I want to take a loan, but I cannot make a payment of 40,000 rupees every month. This is not affordable for me. Now, the RBI guidelines will ask bank to change it to 25,000 rupees. Now, don't you think more people can take such loans? The demand for cars will start increasing in the market. Any problem with this argument here? Let me know. It's a very basic idea. Any problem with this argument? On the other side, flip side, what if RBI feels people have too much of money, already they have lot of money, and people are consuming lot of consumer goods in the market, it might cause inflation. We will do exactly opposite. Now, RBI will ask banks to increase the EMI component. Increase the EMI component from 40,000 rupees, and now imagine the EMI will become 55,000 rupees. You want to take a car loan, minimum EMI will be 55,000 rupees. Now tell me, do you think if the EMI component will start increasing from 40k to 55k, more people will take loans? Does it make sense? More people will take loans with the 55k EMI payment? No. The demand for such loans will go down. And if the demand for such loans will go down, what will happen to the demand for such goods in the market? Consumer goods in the market. The demand for consumer goods will also start going down. Is the logic okay with all of you? Is the logic okay? But EMI is individual subject of every bank. My dear, yes, EMI based on the tenure for which loans you are taking, you can choose the EMI. Choose in the sense you want to take loan for 3 years, you want to take a loan for 5 years, you want to take a loan for 8 years. The bank will give you multiple options. But what if RBI will direct the bank, do not provide? Understand my logic. Many of you are asking loans are individual specific, bank specific, etc. Let me give a very simple example. Right now, you want to take a particular loan. You can opt for, let's say, hypothetically, 5 years, 8 years, 10 years. There are three options available to you: 5, 8, and 10. What if RBI will tell the banks, do not provide these kind of loan for 10 years? Simple question, right? You have an option of taking a loan for 10 years, which means EMI would be lower compared to a loan for 8 year or 5 year. What if RBI will simply ask bank, do not provide this kind of a loan for 10 years? Then the option available to you is 8 for 8 years, which means EMI component that you will pay now will start increasing. Let me know, does it make sense to you or not? EMI component that you will now pay, right? That is, instead of taking 10 years, if you take a loan for 8 years, don't you think EMI component will start increasing? Of course, yes, it will start increasing. RBI can do this. RBI can do this. Now, simple question to all of you again. Can RBI do this for specific sectors which is contributing to inflation? Let me know. Can RBI do this for specific sectors which might start contribute to inflation? Of course, yes. That is the reason these are called as qualitative tools. Third one, variation of margin requirements. Variation of margin requirements. Now, I'll take the earlier example only. Imagine the car price is 10 lakh rupees and I said bank will give you a loan of 8 lakh rupees, right? Remaining 2 lakh rupees. The difference is how much? 2 lakh rupees. This is called as margin. This is simply called as margin. And can I say margin is nothing but the amount of money that the borrower will have to pay from his own pocket? Let me know. You want a loan of, right? I want to purchase a car worth 10 lakh rupees. The bank will give a loan of 8 lakh rupees, which means the difference is 2 lakh rupees. Who will give this 2 lakh rupees? The customer from the pocket will have to spend the 2 lakh rupees. That is called as a margin. Now, please tell me, if the margin will be increased from 2 lakh rupees to 4 lakh rupees. Let me know. If the margin will be increased from 2 lakh rupees to 4 lakh rupees, will people take more loans or lesser loans? Let me know. If margin will be increased from 2 lakh rupees to 4 lakh rupees, will people take more loans or lesser loans? All of you will agree, right? They will take lesser loans. Anybody is disagreeing, please do let me know, because most of you have said correctly. I'm happy with that. People will take lesser loans. What will happen to the demand? Demand will start changing. And what if margin is reduced from 2 lakh rupees to, let's say, 10,000 rupees? If margin will be reduced from 2 lakh rupees to 10,000 rupees, now don't you think more loans will be taken now, because people will have to pay lesser amount of money from their pocket? Variation of margin requirements, right? The variation can be done for margin requirement, so that either the demand for such loans will go up or demand for such loans will start going down in the market. This is one more tool which can be used by RBI. Next one, direct action. Next one is a direct action, moral suasion, and publicity. Next three tools, direct action, moral suasion, and publicity. Now let me start with the last one, publicity here. Please observe this ad. Do not buy at anything here. Please don't waste your time. Please do not buy at anything. Now please look at these ads. Tell me, what is RBI trying to do? And by the way, if you have any kind of doubt, these two are the ads which are provided, given by Reserve Bank of India. What is RBI trying to do here? Can I simply say RBI is trying to educate customers? RBI is trying to educate customers regarding various policies of RBI. Create awareness amongst customers. Create awareness amongst customers. This is called as publicity. This is called as publicity. Why? RBI, right? RBI कहता है और RBI says that customers should be aware of various guidelines that the banks are supposed to implement. Customers should have information regarding the policy changes are done by Reserve Bank of India. Only then they can demand appropriate services from the banks. Only then the banks will be concerned about providing quality services to the customers. That is called as publicity. Promote effective public opinion for policy implementation. This is called as publicity. Now, what is moral suasion? Moral suasion basically means trying to persuade. Trying to persuade. Persuade means asking someone to agree. Asking someone, trying to convince a certain other people. That is called as persuasion. So under moral suasion, RBI will try to convince the banks, will try to persuade other banks which are regulated by RBI to follow all the guidelines of RBI. Now how? How will RBI try to persuade these banks? RBI will send a notice to them. RBI will warn them. RBI will call for meetings with them. RBI will basically take a strict or let's say strict notice of what they're doing and ask them to explain what they're doing. So through notices, warnings, etc., RBI will simply ask them to follow the guidelines of Reserve Bank of India. Simply ask them to follow the guidelines of RBI. It could be, for example, PSL guidelines. It could be, for example, reporting guidelines. Whatever guidelines RBI has, the banks are supposed to follow them. If they do not follow them, RBI will try to persuade them or convince them, which is called as moral suasion. And even after moral suasion, if the banks do not follow the guidelines, then RBI will penalize them. RBI will simply impose a lot of penalties on such banks, which is called as a direct action. Right? For example, if you check, if you're reading newspapers, you will know that many of the banks in the last couple of months, especially cooperative banks in India, have been penalized by Reserve Bank of India. Why? What is the reason? Why RBI is imposing penalties? Reason is very simple. RBI has guidelines, right? For example, PSL guidelines, lending guidelines, right? Collection of deposit guidelines, branch opening guidelines. They have so many measures. And if the banks do not adopt, do not follow these measures, RBI will try to persuade them. Even after that, if they do not follow it, then RBI will penalize them. That is called as a direct action. Done? These are set of qualitative instruments which are used by Reserve Bank of India under the concept of monetary policy. Anybody has got any kind of difficulties in any of the tools that we have discussed? Please do let me know. Otherwise, I'll go forward. If nobody has any kind of difficulties, I will go forward now. Sir, why customer will accept a higher amount to an already existing loan? My dear, please understand. What I said was, in case of regulation of consumer credit, if RBI will ask the banks to change the tenure, new loans which are issued will have a higher payment component. The bank will discontinue old product. They will introduce only these two products, which will mean new loans will have a higher EMI payment, which means people who want to take such products will have to pay higher EMI. They will reduce the demand. That is a basic idea. Scheduled commercial bank. SCB means a scheduled commercial bank. Example of non-SLR bonds. The banks will invest in corporate bonds. They are allowed to do that. Banks will invest in other types of instruments in the market. They are allowed to do that. Okay. Margin requirement. The difference between, right, again, there is one more way to calculate margin also. I'll give you one more example. The difference between what is the demand for the loan, right, how much you want to borrow, and basically how much is given, that is called as a margin. Otherwise, right, there is one more way to calculate it. The bank will collect a safety or collateral. Agreed? The bank will collect a safety or collateral, right? Yesterday we have discussed this. Bank will collect a safety or collateral. Now, in the context of safety or collateral, generally they will take 100% safety or collateral, right? Now, imagine the collateral value, right? The collateral value will be 8 lakh rupees, and the value of the loan that you want is, let's say, 10 lakh rupees. The difference between this is called as a margin, right? The difference between this is called as margin. Okay. Again, don't worry about this. If you have not understood anything in case of margin requirement, simply say how much is the down payment component. How much is the payment done by the right borrower from their own pocket. If that margin increases, automatically, right, the loans taken will also keep on changing. Direct action simply means RBI will impose penalties. I do not understand some of the students, right? These are asking direct action. RBI will impose penalties because you are a bank, you are not following guidelines. RBI will impose penalties. How difficult is it to understand? Right? How difficult? So understand this. In spite of giving guidelines, why can't RBI give binding order? If you do not trust me, right, despite saying this, right, people will not trust me. Please check online at least. If you don't trust me, please check online. No. Go to Google and simply type RBI penalizes. RBI penalizes plus bank. RBI penalizes plus bank. You check it, right? Because doesn't matter how many times I'll say, you will not listen to me. Right? Despite giving guidelines, many banks will not follow. Right? They have their own issues that they will not follow. Then RBI will impose penalties. That is called as direct action. Okay. Moral suasion is just right, just an advice, just right, basically a warning. They are not penalizing them. They are sending a warning to the banks. Follow them, otherwise we will penalize you. That is moral suasion. Okay. Now, let me go to the next one. Concept of money supply, monetary aggregates. Concept of money supply or monetary aggregates. Okay. Now let's start. Let's start. Money supply or monetary aggregate. Now, what is this idea of a money supply or monetary aggregates? RBI will create money. RBI will print money and supply it to the market. Supply it to the market. And when RBI will supply it to the market, can I say through fractional reserve system? I'll repeat the statement. RBI will print money, supply to the economy, and through fractional reserve system. And if you ask me, sir, what do you mean by fractional reserve system? Did we see the idea of a commercial bank money day for yesterday? Sorry, yesterday only, not day for yesterday, yesterday. Through fractional reserve system, the banks will be creating loans. Banks will be creating credit in the market. Now, question is, if RBI will print 100 rupee and supply to the economy, as a result of this new 100 rupee, overall money supply will change by how much? I'll repeat the statement. Imagine if RBI will print 100 rupee and supply it to the economy, overall money supply will change by how much? Don't say 100 rupee, it will not change by 100 rupee. Please wait. Right? Then you have not understood what is fractional reserve system. If RBI will print 100 rupee and supply 100 rupee to the economy because of fractional reserve system, overall money supply will change by how much? We want to measure that. Now let me ask you one more question. Instead of RBI printing 100 rupee and issuing it in the market, Can the money supply in the economy also change if RBI will change SLR? Think of it. Instead of RBI printing 100 rupee and supplying it, what if RBI will change SLR? Will the total amount of money in supply, total amount of money supplied, will it change? Answer is yes. Anybody has a difficulty here? Answer is yes. If you ask me how, sir, how it will change? My dear, yesterday did we not discuss? If SLR is reduced, banks will have more money to lend. Yes or not? Please do let me know. If you say, sir, you have not discussed, I'll accept my problem. That is my issue. That is my problem. Did I not discuss? Whenever SLR is reduced, banks will have more money to lend, and because of fractional reserve system, overall money supply in the economy will increase. Can we say the same thing even for CRR, cash reserve ratio? Right? Can we say same for CRR, cash reserve ratio? If the cash reserve ratio is changed, don't you think more money will get created, not printed? More money will get created because of fractional reserve system. Let me ask you one more question. RBI is not printing any money, but now people instead of keeping cash in the home will start keeping cash in the bank. Let me know. Right? RBI is not printing any new money. Right? RBI has not introduced new money in the system. But people, instead of keeping cash in the home, instead of simply storing money in the home, they will put this money in the form of bank deposit. Will it increase overall money supply in the economy? Yes or no? Please do let me know. Right? Will it increase overall supply? If you have a doubt, let me give a very simple example. Some of you are saying no. Some of you are saying no. Please understand what I'm trying to convey here. What I'm saying to convey, please understand. Right? Again, not immediately. Some of you will say immediately it will not change, sir, over a period of time. What I mean is, right, for example, you have 100 rupee, you have kept it in a book. 100 rupee, you have kept it in a book. Now you will take that 100 rupee and understand what I'm saying here. The 100 rupee that you have kept it in the book, you are not using it for expenditure. You have simply kept it as storage. You will take that 100 rupee, put it in the bank. Immediately money supply will not change. Any problem with my statement? Immediately nothing will change, because instead of you keeping 100 rupee, you have kept the 100 rupee with the bank. Immediately nothing will change. But don't you think over a period of time, the bank will use that 100 rupee that you have given to the bank, will give it in the form of loan to somebody else? So any problem with my statement when I say, when people will start saving more, start keeping deposits more in the bank, immediately money supply will not change. Immediately nothing will change. But over a period of time, the bank will start using this money and start providing loans. And because of fractional reserve system, after a certain time period, money supply will change in the economy. Anybody has a problem with what I'm saying now? Please do let me know. Anybody has problem with what I'm saying now? Now, point number two. Point number two that I want to discuss here is all the deposits that are there in the banking sector. All the deposits that are there in the banking sector do not have the same liquidity. Do not have the same liquidity. For example, if there is a time deposit and if there is a demand deposit. Now, can I simply say the demand deposit has higher liquidity compared to time deposit? Right now, can I simply say that the demand deposit has a higher liquidity compared to time deposit? Point number three, between time deposit, demand deposit, and cash that is there with us, the cash that is there in my hand, that is there with us, can I say time deposit has a lowest liquidity, whereas a demand deposit and cash that is there with us will have higher liquidity? If you have any doubt in any of the points, please do let me know. Okay. Now, point number three. Imagine in the economy. We have 100 rupee cash. In the demand deposit form, we have 200 rupee. And in the time deposit form, we have 300 rupee. Total amount of money is how much? 600 rupee in the economy. Total amount of money is 600 rupee. Total amount of money in the circulation, in the economy is 600 rupee. Now, within this 600 rupee, can I say the 300 rupee, that is, if I write 1, 2 and 3, the 300 rupee, that is 2 plus 3, has a higher liquidity, whereas this 300, that is point number 1, has a lower liquidity. And finally, based on this, let me know, finally based on this, if I'm looking at only 2 plus 3, can I say it is basically narrow money? Narrow money means I'm not looking at overall money. We are not looking at overall money supply. We are looking at only part of the money supply. Any doubt here? We are not looking at overall money supply in the economy. Overall money supply in the economy is how much? 600 rupee. Are we looking at overall money supply in the economy? No, we are looking at only a part of this money supply. Can I call this 2 plus 3 as a narrow money? Anybody has a problem? Please do let me know. Anybody has a problem? If you say, please repeat which point, tell me which point. Simply don't say repeat. Then I'll have to start from beginning. What is economics? Which point? Please tell me that. Point number 2. Arey Baba, I'm saying time deposits are there in a bank. Demand deposits are there in a bank and we have cash. Correct or wrong? We have cash. I am saying time deposit has a lesser liquidity compared to demand plus cash. Any problem with this? I know, right? Many of you are saying, but cash has highest liquidity. I know that. But am I saying that in the form of statement? Listen to what I say. I'm saying time deposit has a lesser liquidity compared to demand deposit and cash. Any problem with point number 2? Now come to the point number 3. Imagine in India, 300 rupees worth of time deposits are there. 200 rupees worth of demand deposits are there. And in India, we have cash of, let's say, 100 rupee. Cash with all of us put together is 100 rupee. Apply the same point as number 2. Apply the same point. Now, total money in India is how much? Total money in supply is how much? 600 rupee. But out of this 600 rupee, what I'm saying is, if you take 200 rupee, that is a demand deposit, and cash with public, cash with us, 100 rupee, that will become 300 rupee. Correct or not? That will become 300 rupee. Now, out of 600, if I look at this 200 plus 100 rupee, am I looking at overall money supply or am I looking at only part of the money supply? At least tell me this question. If out of 600 rupee, I'm looking at the 200 rupee and this 100 rupee, that is demand deposit plus cash that is there with us, am I looking at overall money supply or only part of the money supply? Part of the money supply, right? Only some of the money supply. And this money supply, I'll call this as a narrow money. Why narrow money? Liquidity of demand deposit is higher, as well as the cash liquidity is very higher. What is liquidity? Liquidity means it is the feature of the asset, how quickly you can convert this into asset. Liquidity here simply means the feature of the asset, how quickly you can convert this into asset. Arey Baba, did we not discuss all of this? Those students were asking what is time deposit, what is demand deposit. Why do you not revise what we are discussing? Let me know. Right? Those who are asking and others also, please pitch in. Did we not discuss time deposit yesterday? If I'm wrong, please do let me know. I'm willing to correct myself. Did we not discuss demand deposit yesterday? You don't remember. In 24 hours, you are forgetting everything. In 24 hours, you are forgetting everything. My dear, be very, very careful about it. Right? So, can I now say, come to the third point now. Can I now say 2 plus 3? That is basically the cash that is there with all of us plus demand deposit. Can I say if I look at only this, it is narrow money? Can I say it is narrow money? And if I add even this time deposit, if I say simply 1 plus 2 plus 3, right? Am I looking at a narrow money supply or am I looking at broad money supply now? I'm asking add 1 plus 2 plus 3, right? 1 plus 2 plus 3, am I looking at narrow money supply or am I looking at broad money supply? Can I say I'm looking at broader money supply? Some of us saying narrow now. My dear, listen. If I add 1 plus 2 plus 3, all the three, not 2 and 3, if I'm adding 1 plus 2 plus 3, am I looking at only part of the money supply or overall money supply in the economy? Overall money supply, can I say this is a broad money? This is a broad money. Now, please tell me based on this, between narrow money and broad money, which will have more liquidity? Between narrow money and broad money, which will have more liquidity? Can I say narrow money will have more liquidity? Some of us saying broad. Why? What is difficult in all of this? What is difficulty? Right? Let me know. What is difficulty? Sir, why narrow money will have more liquidity? My dear, time deposits. Right? After finishing the whole story, you keep on asking questions. Time deposits, do they have more liquidity or less liquidity? Everything is there right in front of you. Right? The time deposits, do they have more liquidity or less liquidity? Less liquidity. Are they present in narrow money? Are they present in narrow money? No, this is not present in narrow money. But are they present in broad money? Yes. So now tell me which money will have more liquidity? Of course, you will have to choose narrow money. Arre Baba. Narrow money itself means this money has a higher liquidity in the economy. Is the logic okay? Narrow money itself means this has a higher liquidity. Broad money means comparatively it has a lesser liquidity. Okay? Now, keep all of this in the mind. Let's start. M0, M1, M2, M3 and M4. M0 is called as monetary base. M0 is referred to as monetary base or high powered money. M0 is referred to as a monetary base or high powered money. M1 and M2 are called as narrow money. M1 and M2 are generally referred to as narrow money, and M3 and M4 are referred to as broad money. M3 and M4 are referred to as broad money. Now, what is M0? M0 consists of currency in circulation plus bankers deposit plus other deposits with RBI. I'll repeat the statement here. Right, currency in circulation plus a banker's deposit and other deposits with RBI. So how do you calculate it? I'll just show you a simple example here. Imagine RBI has printed 100 rupee. Can I say 100 rupee can be divided into two parts? That is 40 rupee that will be kept with cash in public or currency with the public. 40 rupees people will keep with themselves, cash with themselves, and remaining 60 rupees they will deposit with the bank. Any difficulty with this? Please do let me know. Step number 1, 100 rupee if RBI has printed and issued it in the market, how can we generally divide it? We will keep certain amount of cash with ourselves. Remaining 60 rupee we will make a deposit in a bank. We'll keep it in the form of deposit in the bank. Now, can I say 40 plus 60 is nothing but currency in circulation? Let me know. Can I say 40 plus 60 is nothing but currency in circulation? That is basically the idea. Currency in circulation. Plus banker's deposit. What do you mean by banker's deposit? Do you remember CRR? Let me know. Do you remember CRR? Cash reserve ratio. What is CRR? Banks will keep deposits with RBI. Bankers deposit with RBI. And other deposits with RBI. What about central government deposit with RBI? What about state government's money with RBI? Can I say other deposits with RBI is basically this? Anybody has a problem with all of this? Let me know. Anybody has a problem with whatever calculation I've given in Formula 1? Formula 1. Currency in circulation, that is how much money has been printed by RBI and issued, plus how much money is kept with the RBI by banking sector, and how much deposit both central government and state government and other institutions have kept with RBI. That is M0. This is called as a monetary base. This is called as a high powered money. This is called as a monetary base or high powered money. That is the name for M0. Now, please tell me, please tell me, if currency in circulation increases, think of it. Currency in circulation increases, what will happen to M0? Let me know. Right? If currency in circulation increases, what will happen to M0? M0 should start increasing. And if M0 increases, please do let me know what will happen to overall money supply in the economy. If M0 increases, overall money supply, overall is important. What will happen to overall money supply? Can I say overall money supply will also start increasing? Now, please tell me, does it make sense to call this M0 as a high powered money at least now? Yes or no? Please do let me know. Does it make sense to call this M0 as high powered money? High powered money means what? This money has huge amount of impact on overall money supply. If high powered money starts increasing in the economy, overall money supply will also start increasing. Any problem? Can I go forward now? Can I go forward? Now, there is a component called as M1. Formula number 2. There is something called as M1. M1 and M2 both are narrow money. Now, in M1, please understand, I'll give a very simple example. Let me know. There are, right, I'll just take a simple number here. Imagine people have kept 500 rupee in the form of time deposit with the bank, 300 rupee in the form of a demand deposit with the bank, and 100 rupee the people have cash with themselves, currency with public, right? Currency held by public. People have 100 rupee with themselves. Now, can I simply say, out of all this money which is there in the economy, out of all of this money which is there in the economy, if I have a narrow money, if I want to calculate a narrow money, I will not consider 500, I will consider 300 rupee and 100 rupee within this example. Anybody has a problem with this? I'll repeat it again. 500 rupee people have kept in the form of time deposit, 300 rupee demand deposits are there in the banking sector, and 100 rupee people have in the form of cash. If I want to find out how much is the narrow money, how much is the narrow money out of all the money in the economy, I will not count 500. I will simply count 300 plus 100 rupee. Anybody has a problem? Right? That is currency held by the public. That is cash with the public. Demand deposits with the banking sector plus other deposits with the Reserve Bank of India. Because Government of India, state government, any point of time they want to withdraw, they can withdraw the money from RBI. That is the reason I said M1 is a narrow money. Anybody has a problem with this? M1 is a narrow money. Currency in circulation in M0 only include cash with the public? No. Right? Have a look at this. I'll write a short form of this. Currency in circulation. Currency in circulation generally is the sum of deposits that the people keep with the bank plus cash that they keep with themselves. Anybody has a problem? Let me know. Right? A cash in circulation or currency in circulation is a sum total of deposits that the people keep with the bank plus cash that they keep with themselves. That is the reason I started with this example. 100 rupees rupee printed by RBI. Out of that, 40 people will keep with themselves. Remaining 60, they will keep it in the form of deposit with the bank. That's the reason I said add both of them, you will get currency in circulation. Can we go forward now? Now, this is M1, right? Please look at M1. Can I say M1 has a very high liquidity? What is the importance of all of this? Just give me some time. You will only answer to me. Please give me some time. You will only start answering the importance. Come to M2. Come to M2. You will take M1 as it is. In addition to this, you will add, in addition to M1, you will also take the component of post office savings deposits. That is, certain people will have kept their money in the form of post office accounts. Have you heard of post office accounts? Please do let me know. Even the post offices in India have accounts. They have account facilities. So certain people will keep their money, right, in the form of post office deposits. In M2, we will count even the post office deposit. Sir, why? Why post office deposit separately? Please understand. Point number one, why we are trying to do all of this circus? Some of you might be thinking, this is so technical. Why are we discussing all of this? Simple question to you. If you are RBI governor and in the upcoming monetary policy, in the next monetary policy, you will have to take a call. Should we increase the CRR? Should we decrease the CRR? Should we increase SLR? Should we decrease SLR? Should we print more money and supply in the economy? Should we reduce repo? Should we increase repo? On what basis will you take a decision? I hope you understand this. On what basis will you take a decision? Don't you think you should have a measure to find out how much total credit is getting created in the economy? Let me know. Does it make sense to you or not? Should you have a measure to find out how much total credit is getting created in the economy? How much is the total money circulated in the economy? Because of fractional reserve system, how much is the total money circulation? If RBI will increase money supply by 100 rupee, overall money supply will increase by how much? If RBI will reduce the supply by 100 rupee, overall money supply will decrease by how much? For all these reasons, the RBI will calculate all these indicators. And just give me some time. You will only answer whether this makes sense or not. Come to M3. Come to M3. Or before going to M3, please tell me. I'll give a statement like this. M2 is more broader compared than M1. I'll repeat the statement. Let me know whether this is correct or wrong. M2 is more broader compared to M1. If this kind of a statement is given, all of you will say yes. Why? Wrong. My goodness. Broader means what, my dear? Tell me now. And you people are not listening. You people, definitely I can say you are not listening. What do you mean by broader? We are covering more money in the supply or we are covering lesser money in the supply. Now, please tell me, are you not covering more money within the economy which is supplied under M2 compared to M1? Simple question. Broad and narrow means what? Narrow, very less coverage of total money circulation. Broad means more money, right, under coverage compared to overall circulation. Can I now say, at least look at the terms and tell me, can I now say compared to M1, M2 will cover more money that is getting circulated in the economy? Yes or no? Right, M2, some of you are saying no. How? What is your argument? Can I write it in simple way like this? Even now, some of the students are saying no. I do not understand. 10 rupee is M1. M2, I'm saying 10 rupee plus post office deposits. Even now, some of you will say, sir, M2 is covering less amount of money. How? How? Right, wake up, wake up. Right, early morning class, I know, please wake up, but. Okay, so M2, right? I'm not saying M2 is broad money. I'm saying M2 is more broader compared to M1. M2 is more broader compared to M1. Okay, now come to M3. M3 is called as, right, broad money. M3 and M4, they'll be referred as broad money. What do we do in M3? M3 we will take M1 as it is plus time deposit with the banking sector. How much is the total time deposits that are there in the banking sector? You will add, right? We will add in the form of, right, the time deposits here in M3. Now you will ask me, sir, why? Why are we adding in M3 time deposit? Very simple. Can I say fractional reserve system? fractional reserve system will work out even in case of time deposits that are held with the banking sector. In fact, it is mainly the time deposits that will help us in fractional reserve system. Right? Understand my statement. In fact, it is mainly the time deposit compared to demand deposit. It is more of a time deposit that will help the banking sector in fractional reserve system. Why? Understand the logic here. In case of a demand deposit, can I say that there is no agreement between customer and the bank as to when they will withdraw the money? Let me know. Correct or wrong? Please tell me. Correct me if I'm wrong. In demand deposit, I'm saying there is no contract, there is no agreement between the customer and the bank as to when the customer will withdraw the money. Whereas in case of time deposit, can I say there is a contract? There is an agreement. There is an agreement saying that for certain number of days or years, I will keep 100 rupee with you. For, right, let's say 7 years, I'll keep 500 rupee with you. Now, don't you think because of this, banks would prefer to use more of a time deposit to give loans in the market? But earlier, in case of M1, we have not considered the time deposit. We have only considered demand deposit. That is the precise reason in M3, we will consider even the time deposit. Right? Even the time deposit will be considered because even these deposits will help in increasing creation of credit, increase money supply, etc., etc. Anybody has a problem with this? Anybody has a problem with this? Please do let me know. Okay. Didn't we took time deposit in M1 in another category? Where? Where? Please tell me. Where have I taken? You tell me. Have I told you time deposit in M1? No, I've told only demand deposit. I said other deposit means the central government deposit with RBI, state government deposit with RBI, etc. And finally, M4. M4. M4 will consist of M3 plus post office savings deposits. Right. Finally, M4, M3 take it as it is plus post office savings deposit. Now, some of you have a doubt, sir, why do we always keep on counting post office savings deposit? Simple question to all of you. Who do you think will create credit in the market? Is it post offices or banking sector? Simple question. Answer it. Who do you think will create credit? Who will create credit? That is, give loans in the market. Is it post offices or banking sector? Don't you think that is the banking sector? Yes or no? Does it make sense to you people? Is it not banking sector? That is the reason we will count M1 and M3 taking only banking sector deposit. Whereas, right, there is also argument which says some people will keep the deposits even with the post offices. Yes or no? Some people will keep post offices a deposit. That is their money in the post offices, especially in rural India. They'll keep their money in the post office savings account. So where do you count that? Right? Where will you account for that? That is the reason we have M2 and M4. And I'll give you a technical statement. Please remember this. I'll give you a technical statement. Please remember this. Post office savings deposits will have lesser liquidity compared to demand deposit, more liquidity compared to time deposit. I'll repeat the statement here. I'll repeat the statement. The post office savings deposits will have, right, lesser liquidity compared to demand deposits in a bank and more liquidity compared to time deposits in a bank. Please remember this statement. And that is a precise reason post office savings deposits will also be counted, but separately under M2 and M4. Any problem now? Can we go forward? The post office savings deposits M2 and M2 are the same? Yes, my dear, both are one and the same. Okay, M3 again. M3 and M4 are referred as a broad money. In case of broad money, what we are doing is we are taking M1, that is narrow money. We are taking M1 as it is. In addition to this, we are taking time deposits that are there with the banking sector because time deposits can also help in creation of credit in the banking sector. The banks will collect, right? Banks will collect, right, the time deposit along with the demand deposit, and they will use these deposits to create loans, provide credit in the market. That is the reason we have taken time deposits along with M1 to call it as a M3. Any doubts? Now, please tell me between M1, M2, M3 and M4, can I simply say, understand this very carefully. As I keep on moving from M1, M2, M3 and M4, can I say liquidity will keep on going down? Let me know now. Can I say liquidity will keep on going down? Anybody has a problem? Second, right, can I say between M1 and M4, M4 is the most broad money supply measure in the economy. Let me know. Can I say M4 is the most broadest money supply measure in the economy? Right, compared to M4, M3 is less broader. Compared to that, M2 is less broader. And the most narrowest is M1. Now, simple question to all of you. Simple question to all of you. Think of this and answer. And this is where application part will become important. Application. You can by heart the formulas. I know that. Right? You can simply by heart it. But what is the meaning? What is the application part? Let me ask you a very simple question. Imagine I will give you 100 rupee. Okay. Imagine I'll give you 100 rupee. This 100 rupee, there are two options. One, you will keep it in the form of savings bank account. Or second, you will keep it in the form of, right, let's say fixed deposit. Now, can I simply say, let me know whether you agree to me or not. Can I simply say, instead of keeping it in the form of fixed deposit, if you keep it in the form of savings bank account, it is because you might withdraw this for consumption expenditure. Correct or not? You have kept this 100 rupee not in FD, but in savings bank account. What is the reason? You will say, sir, I want to withdraw at any point of time. Right? I don't want to wait. I don't want to close FD. Right? I don't want to do all of that. I want it at any point of time. So that is the reason I'll keep it under the savings bank account. And second, fixed deposit. Instead of SB account, if you keep it in the time deposit, that is a fixed deposit, can I say this is because you want to save money, you do not want to consume now, you want to postpone consumption. You want to postpone consumption. Correct or not? Anybody has a problem with this? Let me know. Anybody has a problem with this analysis? Now, look at M1 and M3. Please, right, look at M1 and M3. What if I tell you money supply in the economy is very high? I repeat, what if I tell you money supply in the economy is very high, M1 is also very high. If you're RBI governor, will you reduce repo rate? Will you reduce CRR? Will you reduce SLR? I'll repeat the statement. Think of it very carefully. Some of you are making a mistake here. Think, my dear. Automatically you'll understand. If you are the RBI governor, understand what is the context here. Understand the context. Inflation is very high. Inflation is very high. M1 is very high. Will you reduce repo rate at this point of time? Will you reduce repo rate? Tell me now. Will you not increase repo rate instead of reducing repo rate? Anybody has a difficulty in comprehending what is the argument here? Let me know. Anybody has difficulty in comprehending the argument that I'm trying to make here? Right? Basically, the argument is, some of you are saying, no, sir, we will reduce it. My dear, if inflation is already high, which means money supply is already higher. Correct? Money supply is already very high. And I'm also saying M1 is very high. What is the main component in M1? What is the main component in M1? Main component in M1 is a demand deposit. And I'm saying demand deposit is also very high, which means people have kept money in the form of demand deposit for immediate consumption. They might withdraw the money at any point of time, consume more and more goods and services. Now, don't you think it makes perfect sense for RBI to increase the repo rate rather than reducing repo rate? Any problem in understanding this? If you reduce the repo rate, already the money supply is very high. People are showing an intention to consume more. Are you not increasing money supply further? Will it not cause inflation? Of course, yes. On the contrary, think of this. On the contrary, M1 is decreasing and M3 is increasing. And RBI wants to promote growth in the economy. Please tell me, what will you do? On the other side, another example. M1 is decreasing and M3 is increasing. And RBI wants to promote growth. Right? If you are RBI governor, will you increase repo rate? Some of you are saying increase. No, my dear. Right? Will you increase repo rate? No, you should not increase repo rate. Why? M1 is decreasing, M3 is increasing means what? People are keeping more and more money in the form of fixed deposit. People are keeping more and more money in the form of fixed deposit. They are not keeping money for immediate consumption. They are postponing consumption. At this point of time, if you increase the CRR, money supply will further come down. That will not contribute to growth. That will further pull down the growth. At this point of time, don't you think you should increase repo rate? Yes or no? I'm sorry, you should decrease repo rate. My mistake. You should decrease repo rate, not increase repo rate. Right? Now, please tell me, can you understand what is the importance of M1, M3? Right? Why does RBI use all of them? Right? Why does RBI calculate all of them? In fact, there is one more term here. Please understand. There is one more important term, money multiplier. There is one more important term, money multiplier. What is this concept of money multiplier? If, understand this, it is simply a measure. Right? It's simply a measure that is, if RBI will increase, money supply by 100 rupee, overall money supply will increase by how much? Simple idea. Right? If because of the policies of RBI, right, the monetary base will change, as a result of this, overall money supply in the economy will increase by how much? That is called as a money multiplier. For example, can I say M3 upon M0 is the right formula for money multiplier? Think of it. Right? What I'm saying is money multiplier. What is the meaning of money multiplier? Right? Don't buy out everything. Understand the concept. Money multiplier means what? If because of RBI's policies in the economy, money will change by 100 rupee. That is 100 rupee extra will come into the system. As a result of this, overall money supply should change by how much? That is basically concept of money multiplier. For example, let me know. If RBI will reduce the cash reserve ratio, will money multiplier increase? Simple question to all of you. If RBI will reduce the cash reserve ratio, reduce, not increase, reduce the cash reserve ratio, will money multiplier increase or not? Anybody has a difficulty in understanding this? Please do let me know. If RBI will reduce SLR, will money multiplier increase? If RBI will print 100 rupee, print more currency, print new currency and introduce this in the market, will the money multiplier increase or not? In all these cases, of course, yes, money multiplier will increase. Of course, yes, money multiplier will start increasing. Anybody has a difficulty with this? Please do let me know. Anybody has difficulty with this? UPSC has questioned on all of these. Once more, I'll repeat it again. Money multiplier simply means, understand the logic behind it. If because of RBI's policies, more money or lesser money will be introduced to the economy, as a result of this, overall money supply will change by how much? For example, sir, how it will change? Imagine RBI will reduce the CRR. Simple. Imagine RBI will reduce the CRR from 4% to 3%. Now, question number 1, start answering. Question number 1. If RBI will reduce the CRR from 4% to 3%, will banks have more money to lend in the market? Answer. Will the banks have more money to lend in the... Some of you are saying no. My goodness. Some of you are saying no, my dear. This is very bad now. This is very bad, right? Let's say NDTL is 100 crore. RBI has 4% CRR, which means 4 crore they will have to keep with RBI, which also means they will have remaining 96 crore rupee to use it in the market. Now this will reduce from 4% to 3%. Can I say this will change from 96 to 97 crore rupees? Yes or no? Yesterday we've discussed all of this. It's not as if I'm throwing something new at you people. Yesterday we've discussed all of this. Now the RBI changes CRR. RBI will change CRR, which means, right, the banks will have more money to lend. Now, more money to lend means, please tell me, because of fractional reserve system, FRS, because of fractional reserve system, overall money supply in the economy change or not? At least now they should be clear. Will the overall money supply change or not in the economy? Of course, yes, overall money supply should change. Now, there are certain students who are asking, sir, you have written M3 by M0 as a money multiplier, right? M0 is a monetary base. If monetary base will change, overall money supply should change. Why have you written M3? Why not M4? The answer to this already I've given in the form of a question to all of you. Who creates loans in the market? Is it post office which will create loans in the market, or is it the banks which will create loans in the market? In M4, you are counting post office deposit. Banks are creating loans, not the post offices. That is the precise reason in M3, which we consider only, right, the banking sector, we will take it as a numerator, and M0 monetary base as a denominator. Any problem with this? Let me know. Why are we taking M3 upon M0? Why not M2? Why not M1? Why not M4? Please do let me know. M4, again, Baba, understand, know what I'm saying. Understand what I'm saying. Some of you are saying, but sir, in M4, M3 is there. My dear, in M4, post office deposits are also there. Why are you not looking at it? Do post offices create loans in the market? Let me know if you have taken a loan. Let me know at least now. Please ask anybody, right? Please ask anybody, or you people, your parents, anybody has taken a loan from a post office. Banks will give you loans. That is the reason we cover banking sector. In M3, what is there? M1 is there, correct? In M1, right, plus, right, the idea of a time deposit. We are covering banking sector here. Banks create loans. Post offices, no. Banks create loans. That is the reason we take M3 upon M0. Okay? Let me go to the next one. This is basically the idea of M3 upon M0, which is called as a money multiplier. Some of the books, such as NCRT, will also give you money multiplier formula. I'll write it here only. This is the money multiplier formula. Some of the books, such as NCRT, will also give you money multiplier of M1 upon M0. They will also give you a formula of M1 upon M0. But please tell me, don't you think M3 is a broader concept of money measurement? Let me know. Don't you think M3 is a broader concept of money measurement in the economy, which includes more deposits in the banking sector? Right. So although M1 upon M0 is also used as a money multiplier, the most appropriate, better than this, will be M3 upon M0. This is basically the idea of right, money supply aggregates or monetary aggregates. Can we go forward now? Can we go forward? Anybody has an issue with what we have discussed? Right, please keep on revising. Some of you people don't revise it. Some people don't revise. That's the reason everything will become new for you. Revise, automatically you'll understand all these concepts are right, very interesting, very much very much applicable to UPSC exam. Now come to this. Yesterday, if you remember, there is a concept of transfer of surplus. Do you remember this? Yesterday we have discussed one section just mentioned. Section 47. Section 47 discusses the concept of surplus transfer. Now, what is a surplus transfer? Point number one, RBI will incur expenditure. RBI will incur expenditure. Correct? Anybody has a problem? Sir, what form of expenditure? For printing currency notes, for distribution of the currency notes, for payment of salaries to the RBI employees, etc. Expenditure is incurred by RBI. Second, point number 2, RBI will also earn income. Very simple. RBI will also earn income. Sir, how RBI will earn income? Best example, bank rate, repo rate, etc. Plus, right? Or this is the only source of income? Of course, no. RBI will purchase a huge amount of government securities. RBI will purchase a huge amount of government securities. Not from Government of India. Please remember, not from Government of India, from all of us. From banks, from other institutes, etc. Now, please tell me, if a government security is purchased by RBI, let's say at 90 rupees, and has a face value of 100 rupee, don't you think if that government security matures today, if that GSEC matures today, RBI will get principal of 100 rupee plus a coupon rate? Let me know, yes or not. Anybody has a problem with this? RBI has purchased a government security from us at 90 rupees. Face value is 100. Today the government security will mature. Don't you think RBI will get coupon rate from the government plus principal of 100 rupee? Right. So there are various ways through which RBI will keep on earning money. RBI will earn huge amount of money. Now please understand the next point. If income is greater than expenditure, if income is greater than expenditure, can I call this as a profit? Let me know. If income is greater than expenditure, can I call this as a profit? It's a profitable situation. And in case of RBI, this is correct. In case of RBI, income is greater than expenditure. Now, if RBI is earning profit, who is the owner of RBI? Owner of RBI is Government of India. So the profits should go to whom? It should go to Government of India. Now, please understand, next point is important. Instead of profit, we'll use the term surplus here. Instead of profit, we will use the term surplus. And the reason given by government is, RBI is not a commercial entity. For a commercial entity, we'll call it as a profit. RBI is not a commercial entity. So rather than using the term profit, we will use the term surplus. Now, part of the surplus earned by RBI will go to Government of India, and remaining part of the surplus, RBI will keep with itself. Any problem with this argument? I'll repeat it again. Part of the surplus earned by RBI will go to Government of India, and remaining part of it, RBI will keep it with itself. This is dictated under the concept of Section 47 of RBI Act. And how much will go to Government of India? How much RBI will keep with itself? There is a formula. There is a formula which has been given by Bimal Jalan Committee. Remember the name of the committee? There is a formula which has been provided by a committee which is called as a Bimal Jalan Committee, Bimal Jalan Panel or Bimal Jalan Committee. This is basically related to concept of Section 47. Any problem with what I've discussed here? Let me know. Any problem with what I've discussed here? Does RBI make profit? Of course, yes. I've told you just now. I've told you. Arey Baba, just now did I not say that RBI is earning profit? And instead of profit, we'll call this as a surplus because RBI is not a commercial enterprise. RBI is not a company such as Tata Consultancy Services. RBI is not like, right, let's say Infosys company. It's not a commercial entity. That is basically the reason instead of profit, we'll use the term surplus. So part of the surplus will be given to Government of India. Remaining RBI will keep it with itself. And this has been recommended by Bimal Jalan Committee. Any problem with this? What is the formula? Not required. Not required. To understand the formula, now you'll have to understand, right? Have a look at this. To understand formula, you'll have to understand, right? What is this revaluation account? What is this asset development fund? What is this a contingency fund? UPSC, GS paper, they will not ask you all of this. Do not waste your time. They will not ask you all of this. Only for optional paper, we'll have to discuss all these concepts. All these concepts are very much relevant for optional paper economics. That is specifically optional paper 2. But for GS paper, these kind of concepts, do not worry, right? Do not waste your time on this. Can we go forward? Can we go forward? Now, before I go forward, just make an observation here. Just make one observation. Right? The notes issued, the currency notes and currency coins which are issued, these are, right? Remember this, these are generally listed under the concept of liabilities of RBI. I'll repeat the statement and I'll tell you the logic behind it. The notes, currency notes or currency coins which are distributed by RBI, these are listed under the component of liabilities of Reserve Bank of India. Now, many of you will have this kind of a doubt. Sir, why? Why is the note issued by RBI? Why is it listed under the liability? I'll give a very simple example. Imagine RBI has printed a 100 rupee note and you are a bank. I'm the RBI, you are a bank. I will give you this 100 rupee note. I'll give you this 100 rupee note. Please tell me, right? Will I simply give it, or in return, will I collect something from you? Let me know. I've printed 100 rupee note. I want to issue this in the market. I want this new 100 rupee note to enter into the market. Will I give this, right, simply to you, or will I collect something from you in return? Think very carefully, my dear. Think very carefully, right? If I give you, right, simply 100 rupee, don't you think that becomes a charity? Let me know, right? If I give you 100 rupee, don't you think that becomes a charity? Right? Please understand, RBI will not do that. What RBI does is simple transaction. Here is RBI. RBI will give 100 rupee to a bank. RBI will give 100 rupee to a bank. Now in return, bank will give 100 rupee worth of G security asset. Right? 100 rupee worth of G security will be given to RBI. Now can I simply say for Reserve Bank of India, for RBI now, right, a G security is an asset? Let me know. Any problem? Asset means what? Anything that will fetch you returns is called as asset. Very simple. Anything that will fetch you returns is called as asset. So RBI has collected 100 rupee worth of G security. So they will basically list, right? They will basically list this 100 rupee worth of asset on the asset side. The 100 rupee worth of asset, they will list it. They will mention it on the asset side, and this 100 rupee cash, they will write it on the liability side. Right? They'll simply write it on the liability side. This is a technical idea. This is basically a technical concept of why the currency notes issued by RBI are kept under the concept of liabilities. Okay. Now, what are the other functions of a Reserve Bank of India? What are the other functions? One, this is called as a banker to bank. RBI is referred to as banker to bank. Now, please understand, in the context of banker to bank, RBI is also referred to as bank of last resort. I repeat, this was asked by UPSC. Please understand this. Right? The concept of banker to banks, they will also refer to this as a bank of last resort. What do you mean by bank of last resort or banker to bank? Please tell me if I'm wrong. The banks can always go to Reserve Bank of India and borrow from RBI. Anybody has a problem? The bank can always go to RBI and borrow from RBI during normal times. What if there is emergency? What if the bank is in certain crisis mode? The bank is facing certain issue. There is an emergency with the bank. Even now, this bank can approach Reserve Bank of India and borrow from Reserve Bank of India. And because even during the period of emergency, the banks can approach RBI, borrow from RBI. This is the reason why RBI is referred to as bank of last resort. Okay, next one. RBI is a regulator of the banking sector. Of course, yes. You want to start a bank, take a license from RBI. You want to open number of branches, RBI will say how many in villages, how many in cities. You want to open ATMs, RBI will tell you how many in the villages, how many in cities, etc., etc. So all the regulations in the banking sector are conducted by RBI, hence regulator of the banking sector. Next, RBI also manages forex. RBI also manages, it is the custodian manages forex reserves. What do you mean by forex reserves? Forex reserves basically are foreign exchange reserves. For example, forex reserves will have a component such as gold, STR, special drawing rights. Third one is a foreign currency asset, and fourth one is reserve tranche. Sir, what do you mean by gold? RBI keeps on purchasing lot of gold and keep it with itself. Why? Please understand. Is only RBI doing this? Absolutely no. Many banks around the world, are doing this. And this is generally done by the central banks. The reason being, whenever there is a very high rate of inflation, central banks prefer to invest in gold and keep it because the gold prices over a longer period always increase. Any problem with this? Gold prices over a longer duration, not in a short duration, over a longer duration, always keep on increasing. Whereas if there is a very high rate of inflation, because of a higher rate of inflation, many of the other investments that are done by the central bank, the real rate of returns will be eaten away by inflation. That is the precise reason banks prefer to keep more and more gold reserves compared to making investment during a period of inflation. Any problem with this? Let me know. Any problem with this? Right? Central banks, based on their requirement, they will purchase more gold or offload gold, sell more gold in the market. Second one is STR, special drawing right. Please read what is written in the bracket here. Please read. Right? We'll cover this under IMF. Next one is foreign currency asset. For example, what if RBI is holding means keeping dollar. What if RBI is holding pound? RBI is holding euro. RBI is holding yen, yuan, etc. In addition to this, what if RBI is purchasing government bonds of USA government, UK government, etc.? Can I say all of these are foreign currency assets? Let me know. All of these are foreign currency assets, right? So one is gold, second one is a STR, third one is foreign currency assets, and the fourth one is a reserve tranche, or else also referred to as gold tranche. Reserve tranche is also referred to as a gold tranche. We will cover this as well as this separately under IMF. Any problem with what I've discussed? Please do let me know. Any problem with what I've discussed? Can we go forward? Are Baba. And why don't you read what is there in the slide? Did I say reserve tranche we'll discuss now? Right? How? Right? Why? Why don't you people listen? Second point and fourth point. You people will never listen to whatever I say. Right? So there is no point. There is no point in repeating it. Did I discuss a point number 2 and point number 4? Think of it. It shows to the extent of right the attention span. It simply proves how attentive you are in the classroom. Did I discuss point number 2 and point number 4? I said these are part of Forex Reserve. We'll discuss this in IMF. Now, question is repeat point number 2. Repeat point number 4. Why? What are you listening to then? Foreign currency asset. Okay, foreign currency asset. Foreign currency asset, please understand. Basically, this is a basket. Basket means collection. This is a collection of different types of assets in which RBI has invested, but these are in foreign currencies. These are in foreign currencies. For example, RBI will purchase a bond of government of USA. Please tell me, RBI will purchase a bond of government of USA. Can I say this is a foreign currency asset or not? Arey Baba, let me know. Is it a foreign currency asset or not? Of course, yes. RBI will invest in dollars, purchase dollars and keep the dollars. Can I say dollar is a foreign currency asset? Of course, yes. So basically, it is a basket. It is a basket collection, a collection of different types of securities plus foreign currencies. This is point number 3. Sir, yesterday you said G security is safer. So why gold is used? This is done in order to diversify. Please remember this. It is done in order to diversify. Diversify means what? Let me ask a very simple question. Do you think it is always preferable? Imagine you are the investor. Do you think it is always preferable to keep all your investment under only one type of an instrument? Think of it, right? Whether it is RBI, whether it is you, whether it is anybody in the market. Think of it. Is it preferable? Is it safer to keep all your investment in only one type of an instrument? Never. Please don't do that. Never do that. For example, sir, all my money that I invested in the stock market, right? I invested in the shares of Kingfisher company. What do you think happened to the shares of Kingfisher company on one fine day? All the money that I had, I invested in the shares of, let's say, Satyam company. What do you think happened to the Satyam shares of this the shares of Satyam company back in 2007 and 8? So I hope you understand the argument here. The Reserve Bank of India has multiple investment opportunities. RBI says during the periods of inflation, I repeat, during the periods of inflation, it is safer to invest in gold and it will help me diversify my investment. Hence, during periods of inflation, I will purchase more of a gold. And when the inflation will become lower, automatically my gold component will also become lower. Done? Okay. So this is basically the management. This is basically the concept of management of forex reserves. Now let me go to the next component here. DICGC. We are still in RBI only. Right. After this, we'll be done with RBI. DICGC. Right, sir. What is the long form of DICGC? Deposit Insurance and Credit Guarantee Corporation. Right. Deposit Insurance and Credit Guarantee Corporation. DICGC. Now, what is this DICGC? Point number one, DICGC, right, is owned by Reserve Bank of India. It is owned by Reserve Bank of India. Government of India set up DICGC with the passage of DICGC Act of 1961, or under the DICGC Act of 1961, we have an authority by the name of DICGC. Now, what is the role of DICGC? What is the function of DICGC? It will provide insurance coverage to the deposits which are held in the banking sector. I'll repeat the statement here. It will provide insurance coverage to the deposits that are held in the banking sector. Sir, what do you mean by this? Let me explain. Imagine today you will go to the bank, keep, let's say, 2 lakh rupees in the form of deposit. Now, what if the bank incurs a huge amount of a loss? They have invested somewhere in the market. They have given loans to the borrowers. The borrowers have not repaid. The bank has incurred huge amount of a loss. Now, please tell me, don't you think now the bank will find it very difficult to repay the deposit of 2 lakh rupees? What if the bank will get shut down? The bank will be shut down now. It will close. What about your deposit of 2 lakh rupees? That is the reason there is this concept of DICGC in India, where whenever the banks will collect deposits, they will have to pay 12 paise for every 100 rupee. This is paid by the banks themselves, not by the customer. This is paid by the banks themselves. So the banks will pay an insurance premium of 12 paise for every 100 rupee, and it is this authority DICGC which will provide insurance coverage of up to 5 lakh rupees for these deposits. It will provide insurance coverage of up to 5 lakh rupees to these deposits. That is, in this case, if the bank will close, the DICGC will provide me the insured amount. That will be 2 lakh rupees here. Right? This is the role of Deposit Insurance Credit Guarantee Corporation. Earlier, the insurance coverage was only 1 lakh rupee. Now this has been increased to 5 lakh rupees. With effect from 4th of February 2020, this has been made 5 lakh rupees. Now, which banks will be covered under this? What kind of banks will be covered under this? Please understand. Any entity which will get a banking license. I repeat, any entity which will get a banking license by default will come under the coverage of DICGC. Is the logic okay? Please do let me know. Right? Any entity which will get a banking license from RBI by default will come under the coverage of DICGC, which means tomorrow you apply for a bank license to RBI. RBI will give you a license. By default, you will be under DICGC. You will be covered under the DICGC. Right? That is the reason public sector banks, private sector banks, payment banks, small finance banks, cooperative banks, etc. The list is very long. Right? All these banks will be covered under the DICGC. But please remember this. We will discuss cooperatives today. We will discuss primary cooperative societies. The deposits that are collected by the primary cooperative societies, PACS, will not be covered under the DICGC. If you ask me why, sir, why PACS? This is in short called as PACS, Primary Agriculture Credit Societies. Why the deposits collected by PACS will not be covered under DICGC? Please look at the name and tell me, is PACS a bank? Let me know. Please tell me, look at the name and tell me, is a PACS, right? Is it a bank? No, right? This is not a bank. Hence, any deposits collected by primary cooperative societies, primary agriculture credit societies, deposits will not be covered under DICGC. Okay. Now, there is a very interesting question. One student is asking, what about NBFC? NBFC stands for non-banking financial company. Let me know. Right? I don't have to answer this, but you tell me. NBFCs will also collect deposits, by the way. Right? Many NBFCs collect deposits. Right? We'll understand NBFC later. But look at the name. Don't worry about anything else. Look at the name and please tell me, any deposit collected by NBFC, will it be covered under DICGC? Of course, no, it will not be covered. Why? It is not a bank. Some of you are saying, yes, my dear, it is not a bank. Can you listen to me? It is not a bank. And I said very clearly, very specifically, categorically, I've told you, if you get a banking license, automatically you will come under the coverage of DICGC. Is it a bank? The name itself says it is not a bank. So deposits collected by NBFC will also not be covered under DICGC. Anybody has any problem? So DICGC provides insurance on maximum 2 lakh or 5 lakh? Up to 5 lakh. Up to 5 lakh. Up to 5 lakh rupee insurance coverage is provided. This was there in the current affairs. Please be very, very careful. Are NPAs of the banks also covered by DICGC? How? NPAs are assets. My dear, please understand. Others, don't worry. We have not covered NPA. I know that. Right? We have not covered NPA. We'll cover it. But those students who are asking NPA, my dear, NPAs are assets or liabilities? NPAs are assets. Again, don't worry. Others, don't worry. Don't start asking me what is NPA now. I'm answering to two people who are asking the same question. NPAs are assets. These are not liabilities. Liabilities of bank are covered under this, not assets. How? Right? You tell me what is the context. Okay. Done? Let's start. So this is basically the concept of DICGC. Okay. Now, this is the end of RBI. This is basically the end of Reserve Bank of India. If you have followed the discussion very carefully, we have covered RBI for almost around 5 to 5.5 hours. We have covered RBI for almost around 5 to 5.5 hours. Why? This is very, very important for UPSC. Very, very important. Right? So that's the reason. Read RBI very carefully. Right? Do not make a mistake in skipping RBI for especially prelims. Questions have been asked. They will be asked from RBI. Let's start. Next concept is a nationalization of banking sector. Okay. Next is the idea of a nationalization of banking sector. Now, what do you mean by nationalization here? Ownership is transferred from the private to government. That is the idea of a nationalization. The first round of nationalization was conducted back in 1970. 14 banks were nationalized by Government of India. Second round of nationalization was done in 1980. 6 more banks were nationalized by Government of India. So 2 rounds, please remember this. In 2 rounds, the Government of India has a nationalized banking sector in India. Now, many of you basically tell me, sir, I looked it into a book. It is not 1970, it is 1969. Some of the books have given it as 1969. I'll tell you what is a technicality. In 1969, government introduced the bill of nationalization of 14 banks and basically went ahead with the nationalization. But the owners of these banks went to the court citing the payment of compensation is very less, etc., etc. As a result of this, Supreme Court of India asked Government of India that this round will not be held valid. Please conduct please make this null and void. Because you are not paying right compensation, this will not be considered as a right way to nationalize the bank. That is the reason again in 1970, Government of India introduced the bill for nationalization, went ahead with the nationalization. All of you understand? Those people who are asking me, right, sir, why it is not 1969, why it is 1970, I am coming across 1969. All of you are okay with this? Right? Owners went to Supreme Court. Supreme Court of India made it null and void. Right? The Government of India again introduced the idea for nationalization in 1970. Second round in 1980, 6 more banks were nationalized. Now, why? Why did Government of India go for nationalization? These are following reasons. Point number one, when you're talking about the nationalization of the banking sector, these are private sector banks. If private sector banks will have to make more profit, don't you think more and more branches will be opened in cities compared to villages? Correct or not? Right? These private sector banks will open more banking branches in cities, not in the villages. They will provide loans to companies, rich people compared to poor people. Now, look at the situation. You're talking about 1970s and 1980s. Government of India decided we should ensure that more loans will be given to poor population in India. More loans should be given to agriculture sector. More loans should be given to weaker sections of the society. That will not be done by private sector bank. So that is the reason Government of India went for nationalization. Point number one, these private sector banks were concentrated in cities. They were providing more and more loans to the rich people, etc. Concentrated means more priority given for them. Second, the branches were set up mostly in cities and not in villages. But even today, don't you think? Tomorrow I'll give you one article regarding this. Even today, think of this. Even today, large number of villages do not have banking branches in India. Right? Say yes. Don't argue with me with this. Right? Tomorrow I'll give you an article. You will only agree with me. Right? Because tomorrow is Friday, by the way. So large number of villages, even today in India, do not have banking branches. Right? Don't you think that will have an impact on credit offtake situation in a rural part of India? Savings are done by rural population, etc., etc. So concentrated in urban areas, loans were not reaching to weaker sections of the society. They were given to big companies, rich people, those people with stable incomes, etc. And it is also the duty of the banking sector to provide institutional credit to agriculture sector. Institutional credit simply means, please understand, from a formal system. Right? Many of you ask me, sir, what do you mean by formal system here? Please tell me, a farmer can take a loan from a bank, correct? Farmer can take a loan from a bank. The farmer can also take a loan from money lender. Now, can I say, whenever the farmers will take loan from a banking sector like this, I'll call this as a institutional credit. Correct or not? Please do let me know. Can be referred as institutional credit. And when the farmer will take from a money lender, can I refer to this as informal credit? Non-institutional or informal credit. Right? So don't you want the farmers to take more and more loan from the banking sector rather than money lenders? Because the rate of interest charged by money lenders is very, very high. So citing many of these reasons, Government of India went ahead with the idea of a nationalization in the banking sector. But post 1990, Government of India has not gone for nationalization. Today, we are going in opposite direction. Today, the objective of Government of India is to not nationalize the bank. Today, it is entirely opposite objective. What is the objective today? Government of India says we will not nationalize. And please remember, there is a committee name for this, Narsimham Committee. We'll discuss Narsimham Committee later. Please don't worry. We'll discuss Narsimham Committee recommendation. Narsimham Committee recommended that we should not go for nationalization. Rather, going for nationalization, allow private sector banks to compete in India. Allow foreign banks to come into India, compete with the banks in India. So post 1991, because of Narsimham Committee recommendation, we have not gone for nationalization. Rather than nationalization, today Government of India is going for consolidation in the banking sector by merging many of these public sector banks. By merging many of these public sector banks. Now, what is this idea of a merger of public sector banks? Point number one. Let's go point by point. Let's understand what are the benefits that the Government of India is trying to derive from the merger and what are the concerns or the disadvantages regarding such a policy. Let's try and understand both the sides of the argument. Point number one, please tell me, if banks are merged, let's say 3 or 4 public sector banks are there, we will merge all these public sector banks. Can we create a very big bank because of this? Simple question. Can we create a very big bank because of this? Now, if a very big bank is created, please tell me, point number one, will they require same number of offices that they required earlier? Think of it. Will they require the same number of offices that they required earlier? Will they require the same number of employees? Will they require the same number of computers? Of course, no. Now, can I simply say cost of operations will start coming down? Let me know. Cost of operations will start coming down. Does it make sense or not? Second, right? Imagine this is bank 1, branch is present in this street. Bank 2 branch is present here. Bank 3 branch is present here. Now I will merge bank 1, 2 and 3. Simple question to you. Rather than having 3 branches in the same street, can we close 2 branches, open 1 more branch in a village or in another city, in another area of the city? Possible or not? Now look at the second point. The banking reach now will start increasing. Third, if bank A, B, C were earlier lending separately, now all 3 banks have been merged. Can I say all the banks when merged, more deposit will be available for this new bank? Does it make sense or not? Bank A, B and C, earlier there were individual banks. Now we have merged all the 3 banks. Now, don't you think this new bank will have more deposits to lend? Resources of the banks can be pooled. Pooled means collected together. We can use these resources in a much better way. Point number 4. Now, this new bank can start providing loans for infrastructure. Why this is important? Follow this point carefully. Infrastructure, example, road. Simple example, road, airport. Now, question number 1 to all of you. Participate. This is how you learn. Learning is important here. You want to construct airport. Tell me, will you borrow small amount of loan, right? Or will you borrow a huge value of loan? For question number 1, will you borrow, right? Let's say 1 crore rupee, 2 crore rupee, or will you borrow 5,000 crore rupee, 8,000 crore rupee, 10,000 crore rupee? Can I say value of the loan will be very high? Value of the loan will be very high. Question number 2, will you borrow it for a shorter duration or longer duration? Think of it. Will you borrow this for a shorter duration or longer duration? Don't you think you want to borrow for longer duration? Correct? Anybody has a problem with this? Right? You would want to borrow large value loan and for a longer duration, because it will take many years for you to construct airport. Forget about generating revenue. It will take many years for you to even complete the airport. But the problem is, imagine there is a very small bank. A is a small bank. B is also a small bank. Now, do you think these kind of smaller banks can provide big loans for a longer duration? Think of it. Do you think these smaller banks can provide big loans, larger value loans for a longer duration? No, they do not have that capacity. But what if I say A plus B plus C, which were smaller banks now, have been merged? Now, don't you think with this larger deposit base they have, they will be able to give infrastructure loans now? Does it make sense to you? Right? So they can start providing loans for right infrastructure. It will promote these kind of loan or lending activity. And finally, right, because these banks were smaller, right, and please trust me, Indian banks compared to global banks are very small, very small. In fact, if you have read the newspaper, you would have come across this. The new HDFC Bank, let me know if I'm wrong. The new HDFC Bank, after the merger of two entities, the new HDFC Bank has become one of the Indian banks in the top 5 global banks now in terms of sizes. In terms of size of the bank, the new HDFC Bank, earlier there were right two different entities. Earlier, there were two different entities of HDFC. They have merged the two entities. Now, this new entity has become from India. From India, this is the bank in the top 10 banks in the global market. So, argument is simple. There are many banks around the world. For example, generally you will come across Chinese banks. If you don't trust me, read the newspapers correctly, you will trust me then. Chinese banks are globally very competitive. What they will do is they have huge asset base. They will go to Sri Lanka, provide loans for infrastructure development in Sri Lanka. They will go to, right, let's say Myanmar. They will go to Mauritius. They will go to Pakistan. They will provide loans for construction of infrastructure. That is how soft power of a Chinese government will start increasing. In case of India, Indian banks are not very large compared to global banks. Now, if you keep on merging these banks, make it larger, can they compete with the foreign banks? Of course, yes, they'll be able to compete. Right? So these are basically some of the advantages. These are some of the advantages. Now, let me go to the concerns or issues related to this. Concerns or issues related to this. Point number one, if banks are merged, right, I said the number of employee requirement will not be very high compared to earlier situation. Don't you think some of the employees will end up losing a job opportunity? Let me know. Don't you think some of these employees who are part of the right banking sector, now they will lose employment? So that is one concern, right? Certain people will end up losing jobs, right? So the loss of jobs is one concern. Second concern is, imagine A, B, and C, smaller banks. Okay, imagine A, B, and C, smaller banks. A will fail. Fail means it has incurred a huge amount of loss. A will close now. Compare this situation with the new situation. A, B, C have been merged into one bank. Now this new bigger bank will fail, will close. Don't you think, compared to example 1, in example 2, impact on the economy will be much greater? Let me know. Right? In example 1, A will fail. There will be impact. No doubt, there will be impact. Second example, A plus B plus C were merged to create one big bank. Now this big bank will fail. So what about this issue, concern regarding, right, a failure of a big bank? Impact will be much, much higher. Third one, work culture from one bank to another bank will change. Right? Generally, customers, right? Let me know if I'm wrong with this. Generally, customers will try to keep the bank, will try to keep the deposits, traders, etc., will try to keep the deposits in a bank, generally with which they have an association. Yes or no? Right? They will have a certain association with the bank. They will try to keep, based on that cultural identity, association, they will try to keep the amount of deposits in those banks. For example, right? Don't you think in a state of Kerala, in the state of Kerala, between Canara Bank, between Canara Bank and Stud, am I audible? Okay, done. Let's start. So next concept I want to discuss is the concept of lending rate. Right? How do banks decide what is the lending rate? Let me explain it. Now understand certain important ideas here. First, understand certain very important points. Now, point number one. Here is a bank. Okay. Here is a bank. Bank will collect deposits. Bank will collect deposits and will give loans. Bank will collect deposits and will provide loans. Okay. Now, when bank will collect a deposit, can I say that bank will pay interest here? Any problem? When bank will collect a deposit, bank will pay interest, and when bank will give a loan, bank will collect interest. Bank will collect interest. But now question is, how much interest will be collected by the bank? How much is the interest collected by the bank? That will be decided by the rate of interest. ROI. I'll write it short form here. Please remember this. By rate of interest charged by the bank. Now, please let me know. On one side, bank will pay interest, and the second, bank will collect interest. Can I call this, that is the first one where bank will pay interest, can I say this is cost of funds for the bank? Let me know. Can I say this is the cost of funds for the bank? Cost of funds. Cost of funds means what? Bank is collecting deposit, and how much money is paid by the bank on this deposit? Cost of funds. So first factor is cost of funds. Cost of funds. That is how bank will decide what is the rate of interest here. This is rate of interest. This is lending rate. Lending rate means, right, how much is the rate of interest charged by the bank? How much is the rate of interest charged by the bank? So first factor that will determine how much is the rate of interest charged by the bank is cost of funds. Second one is, what about cost of operations? What cost of operations? What about cost of operations? For example, you have a bank branch, you will require labor for this, you'll require electricity, you'll have to pay rent, right? You will require computers, etc. So even cost of operations should be considered when you decide what is your lending rate. Third one, what about profit motive? Should you consider how much profit you want to earn when you decide what is your rate of interest? Of course, answer is yes. Fourth point, changes in the tenure. Changes in the tenure of the loans. This is basically called as a tenure premium. Tenure premium, meaning what? Let me explain. Follow this very carefully. Imagine you will give 100 rupee loan. You're a bank. You will give 100 rupee loan to one customer for 2 years, and for another customer for 20 years. Follow this very carefully. You are a bank. You will give loan of 100 rupee for one customer for 2 years, for another customer for 20 years. Now, don't you think by giving loan for a longer duration, you're taking a higher risk here? Correct me if I'm wrong. Think of it and answer. Don't you think by giving a loan for a longer duration, longer tenure, duration or tenure, are you not taking a higher risk? Of course, answer is right. That is the reason we will also include a tenure premium. And fifth one, what about cost of CRR? Let me know. Do you remember cost of CRR? Cost of CRR, negative carry on CRR, etc. Sir, where have you discussed it yesterday? Right, yesterday, the last concept that we discussed was the idea of a cost of CRR. That is, the bank will collect deposits from customer. Part of it will keep it with RBI, that is called a CRR. On this CRR, RBI doesn't pay any interest. RBI doesn't pay any interest to the bank. But the bank will pay interest to the customer even on this CRR amount. That is called as a cost of CRR or negative carry on CRR. Now have a look at it. Can I say that whenever you want to decide what is your lending rate, if you are a bank, if you want to decide what is your lending rate, can I say that these are generally the factors that the banks should consider in deciding lending rate? Can we go forward? Let me know. Right? Don't you think these are generally some of the factors that the banks should decide or should consider in deciding what is their lending rate? Now, in India, how is the lending rate determined? How is the lending rate decided? Right now, there are two systems which are in force. One is called as a marginal cost of funds based lending rate. Second one is called as external benchmarking. I'll come to this. Don't worry. I'll come to both of them. Before the MCLR was introduced from 2016. MCLR was introduced from 2016. External benchmarking was brought in by RBI post 2020 in India. Now, the argument is before MCLR, we had different types of systems. Right, there was one system called as a benchmark lending rate. There was a primary lending rate. There was a base rate regime, etc., etc. There are different types of methods which are used by RBI. But what RBI felt was in all of these earlier systems where the banks used to decide their lending rate, RBI felt that there is an inefficient monetary policy transmission. Understand this concept here? RBI felt that there was inefficient monetary policy transmission. Now, what do you mean by monetary policy transmission? Let me explain it. Let me explain with an example. Now, let's start. Here is RBI. RBI will provide loans to banks. Banks will provide loans to customers. Now, simple question to all of you. What do you think should happen if RBI reduces its rate of interest? Let me know. What do you think should happen if RBI reduces the rate of interest? Don't you think now the bank should also reduce its lending rate? Loans will become cheaper, more credit, more loans will be issued because of this. Anybody has a problem? What is the impact? If RBI reduces its lending rate, what is the impact? More credit will be issued at a lesser rate of interest by the banking sector. Can I call this as monetary policy transmission? Think of it. Can I call this as monetary policy transmission? Transmission means effect. What is the impact? Whenever the monetary policy is changed, what is the impact of that on inflation in the economy? What is the impact of that on loan issuance by the banking sector? That is called as transmission. Now, don't you think whenever RBI will reduce its lending rate by larger percentage, they will reduce lending rate, let's say by 2%. RBI will reduce repo by, let's say, 3%. It simply means more loans should be issued. More and more loans at a lower rate of interest should be issued. But what if I say, understand this carefully, what if I say RBI has reduced its rate of interest by 3%, banks have reduced their rate of interest collectively by 0.5%. Think of it. If RBI has reduced its repo rate by 3% and banks collectively have reduced their interest rate by 0.5%, do you think transmission will be efficient? Right, let me know. Do you think transmission will be efficient here? Efficient means, imagine, I'll give you two systems. One example is RBI will reduce repo rate by 3, banks will reduce by 0.5. Another example is a bank will reduce their rate of interest by 2%. So don't you think in the second example, the loans issued would be much, much higher compared to the first example. Right? I hope you understand what I'm trying to convince you people of. In the second example, more loans will be issued compared to first example. So can I say, right, compared to the second example, in the first example, transmission is inefficient. Transmission is inefficient. Right? So argument of RBI was very simple. Under the earlier systems, right, under the base rate regime, primary lending rate, benchmark primary lending rate, etc., the banks decided their own lending rate. RBI said, right, this is leading to inefficient monetary policy transmission. And don't you think if there is an inefficient monetary policy transmission, one, there is no transparency regarding how the banks are deciding their lending rate. Correct? Let me know. There is no transparency as to how the banks are deciding their lending rate. And second, don't you think the rate of interest which is charged on the customer is unfair? Correct or not? The rate of interest that the banks will charge to the customer is unfair. It is unfair activity by the bank. That is the precise reason from 2016 RBI introduced a system by the name of marginal cost of funding based lending rate, MCLR. Marginal cost of funding based lending rate. Now, what is the concept under MCLR? Now, RBI said these are the parameters on which you will have to decide your lending rate. Very simple. Understand my statement here? RBI said these are the parameters that you will have to consider. Right? No option to you. These are the parameters that you will have to consider when you decide what is your lending rate. And RBI felt that with this new system, there will be transparency in how banks will calculate lending rate. And second, RBI also felt that by including the concept of marginal cost of funds. Now, what is a marginal cost of funds? Marginal means slight change, right? Slight variation. Marginal simply means a slight variation. Now, please tell me, whenever you talk about cost of the funds, will you include repo rate or not? Think of it. Please do let me know. Whenever you're talking about cost of funds for the bank, I've given you example here. Whenever you talk about cost of funds for a bank, right, one type of cost of funds is rate of interest the bank will pay on deposit collected. Don't you think bank will also pay another rate of interest, that is repo rate? Yes or no? Earlier, the bank also used, earlier, right, the repo rate is also there. That is also one of the cost of funds. So argument of RBI was by including marginal cost. Marginal means even a slight variation happens in the cost of funds. Even if your cost of funds will change by small number, then you will have to change your rate of interest. That is basically the idea of a marginal cost of a funding based lending rate. But now tell me, right? Now tell me, imagine RBI will reduce the repo rate in the month of January. Think of this. I'll ask you a question now. Imagine RBI will change its repo rate in the month of January. The bank will reduce its lending rate in the month of September. Do you think this is efficient monetary policy transmission? Let me know. I'll repeat it again. RBI will change repo rate in the month of January, and the bank will change its lending rate in the month of September. So now bank will say, even if you change repo rate, right, you're changing repo rate, and as a result of this, I'm changing my lending rate. So see, right, it is application of marginal cost of funding based lending rate. But don't you think, right, it is an inefficient monetary policy transmission? Unfairly, the banks have delayed reducing their interest rate for more than 7 to 8 months. That becomes a problem. That is a problem. RBI said this is a problem then. And that is the precise reason now, right? Have a look at this. Now, in the last 2 to 3 years, RBI has introduced a new system by the name of external benchmarking. Very, very famous now. RBI has introduced a new system by the name of external benchmarking. Now, what is the concept of external benchmarking? Follow the discussion very carefully. Imagine here is a bank. Okay, imagine here is a bank. This bank is giving a loan under the concept of external benchmarking. And if you want to understand any example of external benchmarking, today housing loans are provided under external benchmarking. Housing loans are provided under external benchmarking. Now the bank will basically connect its lending rate. I repeat, bank will connect its lending rate to an external parameter. The bank will connect its lending rate to external parameter. And if the external parameter will start moving upwards, lending rate will go up. If the external parameter will fall down, right, the lending rate will also fall down. Let me prove it to you. Let me prove it to you. Imagine this is how the bank will provide a housing loan to you. They'll say this housing loan will be having a lending rate of a repo rate plus 2.5%. Okay, repo rate plus 2.5%. Sir, why this 2.5%? My dear, profit, cost of operations, etc. Right? So repo rate plus 2.5%. Now, can I say repo rate is this external parameter that I'm talking about? Anybody has a problem? Repo rate is this external parameter that I'm talking about. Why this is called as an external parameter? Please tell me, can SBI change repo rate? Anybody says yes, please do let me know. Can SBI change repo rate? Can Punjab National Bank change repo rate? Can HDFC Bank change repo rate? Of course, no. Repo rate is out of their control, external parameter. Now think of this. If repo rate is 5% now, if repo rate is 5%, what will be the lending rate? Lending rate, that is the rate of interest, will be 7.5%. Any problem? If repo rate is 5%, what is the rate of interest on this loan? 7.5. If RBI will reduce its repo rate from 5% to 4%, if RBI will reduce its repo rate from 5% to 4%, what will happen to the rate of interest on the loans? 6.5%. What if RBI will increase the repo rate from 5% to 6%? What will happen to the rate of interest on the loan? Rate of interest on the loan will become 8.5%. Now, can I simply say, right, this lending rate of a bank, this lending rate of a bank is connected to the external parameter. And when external parameter will change, automatically the lending rate of the bank will also keep on changing. Now, don't you think there is a better transparency in how loan rates are decided? Let me know, right? Is the logic okay with all of you? Don't you think there is a better transparent method in how lending rates are decided by the banks? And don't you think this new system is fair to both customers as well as the banks? Because when the repo rate will start increasing, bank will increase the repo rate. And when repo rate will decrease, a bank will transfer the benefit to customer. So it is fair to both the lenders as well as borrowers. This system is called as external benchmarking. This system is referred to as external benchmarking. Can we go forward? Any problem with this? Who can change repo rate? My dear, after 6 hours of RBI, if your question is who will change repo rate, then I don't know what to answer you people. Right? I absolutely am flabbergasted. After 6 hours of RBI, since yesterday we have been discussing RBI. Now the student is asking who will decide repo rate in India? Great. Right? Any problem with this? Any problem? Can we go forward? Why do we take this 2.5%? My dear, the cost of operations, the profit motive, etc. I said consider this, all of this put together as 2.5%. Can we go forward now? Now, many of you will simply say, sir, how often does the bank change these rates? Please check if anybody has a lending rate, or sorry, if anybody has taken a housing loan or a vehicle loan. If not you, if your parents have taken, if not your parents, if relatives have taken, check it and let me know. Once every 3 months, the banks are supposed to go for external benchmarking. Let me know if I'm wrong. I have a housing loan, so I can tell you with confirmation. Once every 3 months, the banks will have to adjust with their external benchmark, which ensures that if RBI will reduce the repo rate in the month of January, you will get it in the next 2.5 months. You will get the benefit very quickly compared to earlier system where the banks could delay it by 6 months, 8 months, etc. like this. Okay, done. Can we go to the next point now? Let me know. Can we go to the next point? This has been recommended by Janakaraj committee. The banks have four options. External parameter, the banks have four options. One, they can use a repo rate, which most of the banks are doing. Or they can use a yield rate of 91 day or 182 days, right? As 182 days yield rates of treasury bills. Or else there is one more parameter authority in India. There is one authority, institution, Financial Benchmarks of India Limited, FBIL, Financial Benchmarks of India Limited. Any parameter that is published by FBIL. Done. That is basically the concept of external benchmarking. Can we go forward now? Can we go forward? There are two students who are asking what is treasury bill. No way. I'll not keep on going back again and again. Right? No point. If you're not revising, no point. You'll keep on asking everything as I keep on moving forward. Any genuine questions, I'll be very happy to address. But if you're not revising, what is the point? RBI won't practice MCLR now. There are certain loans which are under MCLR, but RBI is trying to ensure, right, there is transparency in that system as well. So profit of the banks will be decided by tenure premium, operation cost, and carry on CLR. No, my dear. Hey, don't you think profit, the bank will want to earn profit apart from tenure premium, apart from everything else? Arey Baba, you put yourself in the place of a bank. Don't you think that will be different? How? 2.5% above repo rate is fixed. Arey my dear. But please tell me, those students who are asking these kind of questions, do you think cost of operations for all the banks will be same? Let me know. Please tell me. Do you think cost of operation for all the banks will be same? Is there anyone in the classroom who says, yes, sir, every bank will incur same cost of operation? Profit motive will be same for all the banks? Cost of CRR will be same for all the banks? Then how do you say 2.5% is it always same for every bank? How? I am giving you one example. You people do not listen to me. That is the reason all of this confusion is created. Did I say 2.5% take it as a fixed for every bank? Did I say that? I said take an example. If cost of operation, if your profit motive, etc., it is 2.5%. Don't you think from one bank to another bank it will change? Otherwise, please tell me. If you say that, think at least apply common sense. If you say this is same for every bank, then don't you think all the banks rate of interest will be same for loans? Are Baba, tell me. Apply logic. Please apply logic. If it is same for every bank, don't you think repo rate is same for all the banks? Then, right, repo rate plus 2.5% will be same for all the banks. All the banks will give you loans at the same rate of interest. Right? Tell me, does it make any sense to you? Right? No, I gave you as a hypothetical example. It will change from one bank to another bank. Okay? Do not complicate it. Many of you try to complicate the issue. Keep it always simple. Okay, let me go to the next point now. Okay, let me go to the next point. Certain basic concepts regarding Basel guidelines. Very, very important. Basel guidelines are important. Basel guidelines are important. Why questions have been asked by UPSC under Basel guidelines? Now, okay, before going forward, there are certain students, right? Now, okay, let me ask a very simple question. Right, I said repo rate, this was a formula, repo rate plus 2.5. Now, please tell me, for SBI, State Bank of India, for SBI, State Bank of India, do you think all the loans, I repeat, do you think all the loans rate of interest will be only this much? Think of it. Think, Baba, apply common sense. Don't keep on creating confusions. Apply common sense, no. Do you think all the loans, it will be same, repo rate plus 2.5, fixed, only this number? Of course, no. Of course, no. For example, if there is one loan which is very, very risky for the bank, don't you think in addition to this, they will add risk premium for this loan? Think of it. If one bank is giving a loan, that loan is very, very risky. Don't you think in addition to this repo rate plus 2.5, the bank will add a risk premium, that is a slightly additional rate of interest? That is the reason. Right, so of course, right, apply common sense, you will only understand. The fact is very simple. This is how basic calculation is done. But that doesn't mean that all the loans will carry same rate of interest in a bank. It doesn't make economic sense also. Right, so this is the basic idea. Now, let's go forward. Do not complicate it. Keep it simple. What is external benchmarking? Janak Raj committee stated that we should introduce external benchmark in India. Right, and what is the meaning of it? The rate of interest charged by the bank will be connected to an external parameter, right? And as the external parameter will keep on changing, the lending rates will also keep on changing. Now, if you do not trust me, right, please read today's business line newspaper article. In today's business line news, there is one article regarding cost of funds for the bank. There's a very nice article, cost of funds for the bank. Cost of funds for the bank. Cost of the funds for the banking sector has increased, the article says. Why? Let me ask a very simple question. In the last 1 year, since last 1 year, what has been the inflation rate? Has inflation rate remained less than 4% or more than 4%? Tell me now. I will connect the dots. You will only connect the dots. Okay. Last 1 year, what has been the inflation? Inflation lower or higher? It has been higher. And because inflation has been higher, what do you think RBI has done? What do you think RBI has done in the last 1 year? Don't you think RBI has increased the repo rate in the last 1 year? Yes or no? RBI has increased the repo rate in the last 1 year. So if RBI has increased the repo rate in the last 1 year, what do you think should have happened to the rate of interest on housing loans? Tell me now. In the last 1 year, what do you think should have happened to the rate of interest on the housing loans? Rate of interest on the housing loans have increased. Right? They have become costlier now. They have increased. Why? We are following the concept of external benchmarking in the context of housing loans. Done? Right? Any problem with this? Any problem? Connect the dots. Automatically you'll understand. Connect the dots. Okay. Now, apart from this, right, business line, this was the article. If you have time, right, if you have access to business line articles, please read it. Again, UPSC will not ask you how much percentage, but you will be able to connect the dots, right? And second, in case of Hindu newspaper today, were there any important articles in Hindu newspaper? Yes, there is one article regarding employment in the central page. There is one article regarding employment in central page only. There are two important articles regarding economics only. Please read those. Please read those. Okay, both are important. Okay, now let me go to the next one. Concept of Basel guidelines. Concept of Basel guidelines. Now, what is this idea of a Basel? Point number one, Basel is name of a city. Okay, Basel is a name of a city. Don't ask me, sir, give me expansion of Basel. Basel is a name of a city. It is a city's name. And in this city, there is one institution. I'll come back to this, have patience. In this city, right, which is present in Switzerland, there is one institution by the name of Bank of International Settlement. BIS, Bank of International Settlement. Now, Bank of International Settlement, right, for which India is also a party. India is also a member in the BIS. There is one committee which has been set up by BIS, and the name of the committee is Basel Committee on Banking Supervision. Right, BIS has one committee that is called as Basel Committee on Banking Supervision. And this Basel Committee on Banking Supervision generally discusses and comes out with guidelines to regulate the banking sector. Any problem with this? Please do let me know right now. Right, I'm saying Basel is a city which is present in Switzerland, and in this Basel there is a one bank by the name of Bank of International Settlement. India is a member of it, and within this BIS there is a committee by the name of Basel Committee. And this Basel Committee very often will come out with guidelines regarding banking sector. This is the basic idea. Now, to understand Basel guidelines, you need to understand certain important concepts here. All these are very important. Follow the discussion now. First one is the concept of capital of a bank. Concept of capital of a bank. Now, what do you mean by capital of a bank here? Capital basically means how much is the difference between assets and liabilities. Understand my statement here? How much is the difference between the asset and liability? That is called as a capital of a bank. Now, what is the use of the capital of a bank? What is the use of the capital of a bank? Please understand this. Imagine there is a bank which has an asset of 100 crore. Out of this, liabilities are 80 crore rupees. Can I say the bank has a capital of 20 crore rupee? Let me know. The bank has a capital of 20 crore rupee. Now, what is the use of the capital? What if the bank will incur losses? What if the bank will incur losses? These losses can be absorbed by this capital of a bank. I'll repeat the statement. Understand this carefully. Point number one, what do you mean by capital of a bank? Capital is basically the difference between assets and liabilities. And in this example, I said assets are 100 crore, liabilities of the bank are 80 crore, which means capital held by the bank will be 20 crore. What is the use of this capital? The bank will use this capital if at all there are losses incurred by the bank. Anybody has a problem with this? Let me know right now. Now, the capital of a bank is generally kept in the two forms under two classification. One is called as a tier 1 capital. Second one is a tier 2 capital. Tier 1 and tier 2. Now, please understand, tier 1 capital is referred to as core capital and tier 2 is called as a supplementary capital. Tier 1 core, tier 2 supplementary capital. Now, core capital has more loss absorption capacity compared to the tier 2 capital. I'll repeat the statement. And none of you are replying, by the way. If you do not reply, I'll assume you are understanding it. I'll repeat it. Core capital can absorb the losses much more easily compared to the tier 2 capital, that is supplementary capital. Sir, how? How is that possible? Can you give an example? Let's start. So have a look at this. Core capital, best example is additional tier 1 bonds. The banks in India, I hope you understand this. Banks in India are right now issuing bonds by the name of additional tier 1 bonds. And best example for tier 2 capital is a tier 2 bond. Let me give you what is the meaning of tier 1 and tier 2. Then I'll ask you a question. You will have to answer it. Let's start. Both additional tier 1 and tier 2 are unsecured bonds. Both additional tier 1 and tier 2, both are unsecured bonds. Now, what do you mean by unsecured bonds? Follow this. Imagine, right? Imagine a bond is issued here, and related to bond, a security or collateral is provided. Very simple. A bond is issued, and related to a bond, connected to a bond, a security is there. What is the meaning of it? Imagine I will issue a bond to you. If I don't pay a repayment, if I don't pay the money back, you can take over the collateral. You can take over the security. Now, this is called as secured. This is called as secured. On the other side, a bond is issued. Bond is issued, money is collected, no security, no collateral is provided. This is called as unsecured. Any difficulty in understanding what is secured bond, what is unsecured bond? So both additional tier 1 bond and tier 2 bonds, both are unsecured. Point number 1. Point number 2, additional tier 1 bonds, right? These are perpetual bonds. Perpetual bond means what? Imagine I will issue a bond to you. Imagine this is a bond and the maturity period is 3 years. Right? Example 1. Maturity period is 3 years. Second example, I will issue a bond to you. I will issue a bond to you which does not have any maturity period. I will issue it to you and you will have to keep it, right? You will have to own it until and unless I purchase it back. Can I say example 2 is a bond which can be referred as a perpetual bond? Let me know. Can I say example 2 is a perpetual bond? Perpetual bond means which does not have fixed maturity period. The issuer, I repeat, the issuer will decide when to repurchase it. The issuer might decide to repurchase it after 5 years. The issuer might decide to repurchase it after 10 years. It is entirely up to the issuer. Whereas in case of example 1, I'm issuing a bond to you, and in the bond it is written bond will have a maturity period of 3 years. That is right, the example here. So perpetual do not have a maturity period, right? A non-perpetual, that is a fixed maturity period. Example, government bonds. Additional tier 1 bonds are perpetual bonds, right? Next, whenever the banks are issuing such bonds, I repeat, whenever the banks are issuing such bonds, the banks will basically say, in case in the future, if the bank is under financial pressure, I repeat, the bank is issuing this bond. In future, if the bank is under pressure, financial pressure, the bank may not pay interest, may not pay any interest, and the bank might simply cancel the bond as well. I'll repeat it again. The bond which is issued by the bank says, in future, not now, in future, maybe after 1 year, 2 year, or after 3 year, imagine the banks, right? The bank's finances are very weak. The bank is incurring losses. In such cases, I might not pay coupon to you, that is interest to you, and I might simply say I will not repay the principal only. Right? I will simply cancel the bond. Right? So this is one more very important feature of additional tier 1 bond. Now, please tell me, after looking at all of this, don't you think tier 1 bonds are very risky? Think of it. Don't you think tier 1 bonds are very, very risky? And that is the precise reason tier 1 bonds will carry higher coupon rate. Simple. They will carry higher coupon rate. They offer higher coupon rate on additional tier 1 bond. Right? Because many of you will simply ask, if these are so risky, why people will invest? Why will anybody purchase these bonds? My dear, higher coupon rate. Higher coupon rate. That is basically the attraction here. Right? I'll give you examples also. Please check. Please read newspapers. You people do not read newspapers. State Bank of India very recently has issued additional tier 1 bonds. Right? Earlier, right, the Yes Bank has issued additional tier 1 bonds. There are many banks in India which have issued additional tier 1 bonds and they have collected money. This is a 81 bond. Now come to tier 2 bond. These are also unsecured. Tier 2 bonds are also unsecured. And right, have a look at this. The issuer will decide what is the maturity period before they issue the bond to you. The issuer is deciding, right, that is before the bond is issued, what is the maturity period of the bond. They will decide and they will sell it to you. Right, this is basically tier 2 bond. And third, right, this feature will remain same. Third point, that is in case of tier 2 bonds as well, in case of financial pressure on the bank, coupon payment can be skipped. The bank might simply say, I will not give you coupon payment this year. And the bank might simply say, they will cancel the bonds altogether. They can do even the cancellation of the bonds. Cancellation means the bond will not simply be purchased back, that the borrower will not repay the money. That is the meaning of cancellation of the bond. Now, please tell me, think of this very carefully. Please tell me, imagine, right, through additional tier 1 bond, you have collected 100 rupee capital, by the way. And tier 2 bond, you have collected 100 rupee capital. Now, please tell me, in order to absorb losses, will you rely more on additional tier 1 bonds or tier 2 bonds? After all of this, think of it and please tell me, will you rely more on additional tier 1 bond or tier 2 bonds? As a bank, please understand, think like a bank. Please think like a bank. Most of you are correct. I'm happy. Most of you are correct. Right? Some of you are saying tier 2 bonds. No, my dear, you are wrong. Your reliance on additional tier 1 should be more. You should rely more on tier 1 bonds. That is additional tier 1 bond. If you ask me why, sir, why? I don't think so. 81, it should be tier 2 bond. Right? My dear, in case of 81, you have collected 100 rupee. You will decide when you will return the money. Any problem here? In case of additional tier 1 bond, you have collected 100 rupee. You will decide when you will return the money. After 5 years or after 10 years, etc., you will decide it. Whereas in case of tier 2, you will have to give the money back after 3 years. The maturity period is decided. You will have to give it back after 5 years. Maturity period is decided. So don't you think additional tier 1 bonds, the capital that is collected, has more loss absorption capacity compared to tier 2 bonds? Yes or no? At least now. The additional tier 1 bonds have more loss absorption capacity compared to tier 2 bonds. Again, I can get into the technical concept. There is a technical idea, senior bonds, subordinate bonds, etc., etc. But this point should be okay with all of you. That is, 81 bonds or capital collected under tier 1 can absorb the losses much more comfortably, much more easily compared to capital collected under tier 2 bonds. Right? So this is basically the idea of a tier 1 capital and tier 2 capital. Now, have a look at this. Let me ask you one more question. Based on this information, you please tell me, if the bank will collect a total capital of 100 crore rupees, right, which one should be higher within this 100 crore rupee? Tier 1 capital or tier 2 capital? Let me know. If a bank will collect a total capital of 100 crore rupee, what do you think should be more? Tier 1 or tier 2? Most of you are answering correctly. I'm happy, very much happy with that. Right? Don't you think it should be tier 1 capital, which should be more? Arey Baba, some of you are saying tier 2. After discussing all of this, some of you are saying tier 2. Which has more absorption capacity? Let me know. Which has a more absorption capacity? Tier 1. So don't you think you should collect more in the form of tier 1 compared to tier 2? Does it make sense or not? Right? That's a reason very often you'll come across this when I'm discussing payment bank, when I'm discussing SFB, RBI will ask the banks to keep more of a tier 1 compared to tier 2. Reason is tier 1 can absorb losses much more comfortably compared to tier 2. Okay, done. Now, let me go to the next concept, the risk faced by the banks. The types of risk faced by the banks. First one is called as a credit risk. Second one called as a market risk. Third one called as operational risk. First one is a credit risk. What do you mean by credit risk? The borrower will not make the repayment. Simple. The borrower will not pay the loan. Don't you think the bank is going to face a loss because of this? Simple. Let me know. The borrower, that is the person who has taken the loan, will not repay the loan. Right? Don't you think the borrower, sorry, the creditor in this case, the lender in this case, right, basically will take a credit risk? Any problem here? Can I go to the next one? Why don't T2 cancel if it is cause a loss? Arey Baba, did I not say? The banks have the power to cancel the T2 also. Hey Baba, I've written it. Please listen. Right. Second one is a market risk. Second one is a market risk. Right. Imagine the bank has purchased a government security at 100 rupee, will sell government security at 90 rupee. Is it a loss or not for the bank? Think of it. Right. The bank will purchase the government security at 100 rupee, and after certain time period, they will sell it at 90 rupee. Is it not a loss? But why? Why there is a loss? Why is the bank facing a loss here? Because of movement in the market prices. Because of movement in the market prices. Market prices will keep on volatile, right? Keep on moving up and down, right? As a result of this, right, the market risk will be faced by the bank. The bank can incur losses because of this. Third one, operational risk. The risk, right, which will lead to losses, right, or the risk of losses incurred by the bank because of the systems, because of the people, because of the processes, etc., etc., etc. Let me give a very simple example. Right, let me give a very simple example. Imagine you deposit a bulk cash, huge amount of cash in a bank. The cashier is in a hurry. One of the currency note is a fake currency note. One of the currency note is fake currency note, counterfeit. Because the cashier is in a hurry, he will not find it out. He will accept all the money and basically give you a credit. That is, add in your account whatever money you have deposited. Now, please tell me, this fake or counterfeit currency note that has been accepted by the bank, is it not a loss for the bank? Let me know. Is it not a loss for the bank? Right? So there are many systems, there are many reasons, because of the people, because of the processes, because of systems, banks will face a risk of a loss, which is called as a operational risk. Right? So the banks will face three types of risk: credit risk, borrower will not repay the loan, credit risk. Arey Baba, how difficult is credit risk? Right? Imagine you have given a loan to me, 100 rupee. I will not repay it. Is it not a loss for you? Think no. My dear, simple think. Right? You need to simply think. Apply common sense. You have given a loan to me. I will not give you the loan back. I will not repay 100 rupee. Is it not a loss for you? Credit risk. Market risk. There are changes that are happening in the market. Because of the movements in the market, the bank will face a risk and lead to losses. Market risk. Because of operational, right, because of the systems, because of the people, because of right, technology, etc., right, the bank will face a loss that is called as a operational risk. Can we go forward? Let me know. Can we go forward? Any problem here? Bank will seize his property in credit risk. My dear, right? You're mistaken. You're mistaken because you do not know reality. What is the reality? Point number one. Tell me, think of it and tell me, do you think all the loans issued by the banks will have collateral? Let me see. Let me know. Do you think all the loans, underline the term all, do you think all the loans issued by the bank will have collateral? No. Can I give a best example? Educational loan. Educational loans. Educational loans do not carry any collateral. Educational loans do not carry any collateral. Right? So all the loans do not carry collateral. Do not be under the assumption that whatever is collateral, I will take it, I will sell it. Now, come to the second point. Even if you have collateral, please tell me, will you be able to recover the full value of the loan that you have given? Think of it. Even if you have a collateral, let's assume you have a collateral. Do you think you will be able to recover the full value of the loan? Absolutely no. There is no guarantee. No guarantee regarding this. For example, imagine, right? I'll take a current affairs example only. Kingfisher Company. Kingfisher Company. Thousands of crores of rupees were given by various banks to Kingfisher Company. Now they have offices of Kingfisher Company. They have taken over planes of Kingfisher Company. Do you think the banks have been able to recover all the loans that they had given to the company? Absolutely no. Right? Why? Market prices of the assets will keep on changing. Don't you think this? This would be very much appropriate here. The market prices of the assets will not remain constant, will keep on changing. For example, you took a housing loan. Today, the value of the house was, let's say, 1 crore rupee. You took a housing loan of 90 lakh rupees. Please tell me, if you do not repay the loan, bank will take over the house. If they sell the house in the market, do you think they will collect 1 crore rupee from the market? Do you think they will recover 1 crore rupee from the market? What if this happens during pandemic? Let me know. What if this happens during pandemic? Who will purchase a house from the bank at 90 lakh rupee or 1 crore rupee? Nobody will purchase. Right? The housing prices would have collapsed already. So again, do not complicate it. Start going forward. Okay. Next, basic concepts. Right? Certain more basic concepts. Risk-weighted assets. RWA. Risk-weighted asset. Now, what do you mean by risk-weighted asset? Let me explain this. Follow this carefully. Imagine the bank has given loan to Government of India and it has given loan to one company. Please tell me, is the bank facing the same kind of a risk in these two types of loans? Let me know. I'll repeat it again. The bank has given loan to Government of India and a bank has given loan to a company. Is bank facing same kind of a risk in two types of loans? Of course, no. Now, can I extrapolate the same thing and say, whenever banks are going to invest in a bond, whenever banks are going to provide loans to different borrowers, different amount of a risk is taken by the banks. Now, under Basel, we will give a weightage to all the risky assets. This is called as risk-weighted assets. And what is the importance of this? Now tell me, if there are risky assets held by the bank, is there a possibility of loss to be incurred by the bank? Think of it. If a bank is having risky asset, can there be losses? Again, no guarantee. Can there be losses in the future? Of course, yes. So what do we do? Under Basel guideline, we calculate a concept called as a risk-weighted asset, RWA. Risk-weighted asset, RWA. How? Let me show a very simple example. Do not by heart calculation. UPSC will not ask you this. Imagine this bank is giving three loans. One is 50,000, second one is 30, third one is 20,000. Total assets held by the bank is 1 lakh rupees. Now, right, let's say In case of loan 1, risk weightage is 0%. For example, this loan is given to Government of India. This loan is given to Government of India. Risk weightage will be 0 because government will repay it. Right? Another loan will have a risk weightage of 50. Another loan will have a risk weightage of 80%. How much is the risk weighted assets in loan 1? 0 rupee. Second one, 30,000 is the loan value, 50% is risky, so 15,000. Third value is 20,000, 80% risky, 16,000. Can I calculate and say, in this bank, which has total assets worth 1 lakh rupees, the risk weighted assets are 31,000 rupees. Any problem? Let me know right now. Do not worry about calculations. UPSC will not ask you these calculations. In this example, can I say, right, the loans assets are 1 lakh rupee. The risk weighted assets are 31,000 rupees. How risk weightage is calculated? Basel guidelines have given it. You can download. There is a 500-page document issued by the Basel committee. They say if a loan is given to a company, if it is a real estate, if it is agriculture, all the weightages are given. Right? You don't become an expert here. Right? Now, what is the use of this? Using all of this, we'll calculate one ratio called as capital adequacy ratio. CAR, capital adequacy ratio, or else another name for this is capital to risk weighted assets ratio, CRAR or CAR. What is the meaning of capital adequacy ratio? Let me show with a very simple example. Imagine for a bank, RBI will ask the bank to maintain capital adequacy ratio of 9%. Right? For a bank, right? Imagine RBI will ask the bank to have a capital adequacy ratio of 9%. 9% of what? Of course, it will be 9% of risk weighted asset. What is the meaning of it? What do you understand by 9% of risk weighted asset? It simply means if the bank has a risk weighted assets of 100 crore rupees, now the bank has to have a capital, minimum capital that the bank should maintain is 9 crore rupees. Any problem with understanding this? Please do let me know. Capital adequacy ratio represents to what extent the bank can absorb losses. I repeat, to what extent the bank can absorb the losses, right? Because the bank might incur losses because of RWA. And now, how much is the capacity of the bank to absorb losses? That is represented in the form of capital adequacy ratio. If the bank is having a target of 9%, it simply means for every 100 crore worth of risk weighted asset, the bank must maintain 9 crore worth of capital. Now, within this, can I say, next point is important. Within this, the bank should have more of tier 1 capital. Let me know. Within this 9 crore, the bank should have more of tier 1 capital compared to tier 2 capital. Remember this point. Point number 2. Tell me, how many of you are under the impression that this capital adequacy ratio should be same for all the banks in India? Does it make sense to you? Right? Tell me, should the capital adequacy ratio, should it be same for all the banks in India? Don't you think from one class of bank to another class of the bank, it should be different? It should be different. For example, for scheduled commercial bank, RBI says capital adequacy ratio is 9%. For public sector bank, RBI says make it 12%. For payment banks, RBI says make it 15%. So from one bank class to another classification of a bank, right, the requirement of capital adequacy ratio should be different. That makes perfect sense. Point number 3. Should it be same across the globe for all the countries? Let me know. Should it be same across the globe for all the countries? Of course, no. So now is it okay if I say, if Basel says a certain number should be capital adequacy ratio, RBI should, if required, should have different capital adequacy ratios? Does it make sense to you or not? I'll repeat it again. If Basel committee says we should have, let's say, 8%, can RBI say for India we'll make it 9%? Can RBI say we'll make it 10% for India? Of course, yes. Why I'm discussing all of this, there is a reason. There is a particular reason why I'm discussing all of this. Because many of you will simply say, after you have looked at the slide, you will see, right, certain website which says under Basel guideline, capital adequacy ratio is 8%. Correct. Under Basel guidelines, they will say capital adequacy ratio is 8%. But I would say, in case of India, capital adequacy ratio is 9%. Am I wrong? No. Is that website wrong? No. Because under the Basel committee, they have issued a guideline which says 8%. But RBI says, no, we will not keep it 8%. We will increase it to 9% in India. So both are correct. In UPSC, focus on what is the question they are asking you. I hope you understand. Focus on what is the question they are asking you. If the question says, as per Basel guidance, capital adequacy ratio in India is how much? That's a different one compared to a statement as per Basel guidelines, how much should be the capital adequacy ratio. Okay, come to the point now. There are 3 rounds of Basel guidelines. 3 sets of guidelines have been issued. Basel 1, Basel 2 and Basel 3. Basel 1 was announced in 1988 and it covered only credit risk. Now, I hope you understand what is credit risk. Under Basel 1, only credit risk was covered. And the concept of risk-weighted assets calculation was introduced. And based on this, Basel 1 stated that all the banks should have minimum capital adequacy of 8% of risk-weighted assets. Has India implemented Basel 1 guidelines? Yes. By 1999, India has already implemented Basel 1. Now come to Basel 2. Basel 2 was introduced in 2004. From having only one type of a risk under Basel 2, now we expanded the types of risks. I'll repeat. From having only one type of a risk under Basel 2, now we have 3 types of risk. One is called as a market, second one is operational, third one is credit risk. Now, because of all the 3 types of risks, can the bank face losses? This is very clear to you now. Because of all the 3 types of risks, can the bank face a loss? Can the bank incur a loss? Of course, yes. So, what is the reform then? What should be done by the banks? Point number 1, the banks must maintain a minimum capital adequacy ratio of 8%. They call it as a 3-pillar approach. That is 3 very important reforms. Right? The banks should maintain a minimum capital adequacy ratio of 8%. Point number 2, supervisory review. All the banks should develop their own systems, should develop their own technology, should have their own processes in order to minimize the risk. Very simple. The banks should develop better risk management practices, better risk management techniques in order to manage and reduce the risk they are facing. Right? That is the second one. For example, let me give you a very basic idea. If you take a loan from the bank is facing credit risk. Is the point 1 okay with all of you? If you take a loan from the bank is facing credit risk. Now, if you stop making a payment, bank will not sit quietly. Bank will never sit quietly. They have certain systems put in place where they will send a notice to you. They will ask you, right, sir, madam, from last 10 days, the due date is over. You have not repaid the loan. Please make the payment as soon as possible. Can I say, right, in simple terms, this is nothing but a technique, a management practice that has been introduced to minimize the risk and to minimize the losses because of the risk. Does it make sense to you or not? Right, that is the second one, supervisory review. Supervisor review. And the third one is market discipline. What do you mean by market discipline? All the banks should report whatever they are doing, how much loans they are issuing, how many of them are risky loans, how much is the risk weighted asset, how much is their right credit risk. They should report all of this information to the central bank. That is called as a market discipline. Requires increased disclosures. The banks should mandatorily disclose capital adequacy ratio, risk exposure, etc. to the central bank. This is the three-pillar approach that we are following under Basel II. Now, finally, under Basel III, right? Basel III. Last one is Basel III. After that, we do not have Basel IV. Okay, Basel III. This was introduced in 2010. Under this, we continued with the concept of three-pillar approach. We have continued with the concept of three-pillar approach. Right? Even today, under Basel III, we have three-pillar approach. Point number 2, capital adequacy ratio is 9%. Under this, CAR is 9%. Now, please look at the next point. Please look at the next point. Does it make sense to you now? Out of this capital adequacy ratio, right, you should have highest amount of tier 1 capital. You should have more and more tier 1 capital. 7% of risk weighted assets you should maintain in the form of tier 1 capital. Right? Why? I hope you know the answer already. Why should we maintain more of tier 1 compared to tier 2? I hope you know the answer. Right? Again, when I say I hope, it's nothing that, right, I'm expecting you to get from outside. Already I've told you why tier 1 is better than tier 2. Next one, capital conservation buffer, CCB. Capital conservation buffer. Now, what do you mean by capital conservation buffer here? Right? Think of it. Imagine you have collected 100 crore rupee worth of capital in the form of tier 1 and tier 2. Can I say this much amount of capital should be sufficient to absorb the losses during normal times? Let me know. During normal times, this much amount of capital should be sufficient for you to absorb losses. Now, what if I say there is a pandemic in the economy? What if I say there is a recession in the economy? What if I say the banks are collapsing one after the other in the economy? Now, point number 1, do you think this is a normal situation? Let me know. Do you think this is a normal situation? No, this is never a normal situation. And during such a situation, during the situation of stress in the economy, please tell me what will happen to losses incurred by the bank? What do you think should happen to losses incurred by the bank? Don't you think losses incurred by the bank will start increasing? They will start increasing. And at that point of time, this amount of capital may not be sufficient. This capital that you have may not be sufficient to absorb the losses. That is the precise reason under the concept of a capital conservation buffer. Look at the term buffer. Buffer means extra. Buffers simply means extra, additional. Buffer means extra. Capital conservation buffer simply means in addition to whatever capital you're holding to absorb losses during normal times, in addition to this capital, keep extra capital. Have certain extra capital and call this as capital conservation buffer. And what is the use of the capital conservation buffer? During the periods of emergency, during periods of the stress like this amount of capital will not be sufficient because the losses would be higher, and then start using this additional amount that you have kept aside, that is buffer that you have kept aside. Done? How much buffer you are supposed to keep? buffer has been fixed in case of India at 2.5% of risk-weighted asset. Meaning what? You should have a capital of 9%. You should have a capital of 9%. In addition to this capital, you should also have a buffer of 2.5%. And use this capital. This is also capital. Use this capital only during the period of stress, only during the period of emergency. Right? That is the concept of capital conservation buffer. And finally, liquidity coverage ratio. Last point for the day, liquidity coverage ratio, LCR. What is the liquidity coverage ratio? You as a bank estimate, I repeat, estimate in the next 30 days how much money will be flowing out of the bank. Follow this carefully. You as a bank have an estimation of how much money will be flowing out of the bank. Now, imagine you have estimated in the next 30 days, 100 crore will flow out of the bank. Imagine if your estimation says 100 crore, then 100% of this money, I repeat, 100% of this money, right, keep it in the form of high quality liquid asset. I'll repeat it again. Understand the process here. Why you will understand in a minute. I'll repeat it. You as a bank estimate in the next 30 days how much would be the money flowing out of the bank. Let's say hypothetically it is 100 crore rupee. Then 100% of this you will have to keep it in the form of high quality liquid asset. For example, G security. Can I say G security has got very high liquidity feature? Liquidity here means quickly you can convert this into money. Yes or no? G security has got high quality liquidity. What about the cash? Cash itself is liquid. So there is no question of converting into money. Now question is why? Sir, why should we estimate and why should we keep, right, this much amount of high quality liquid asset? Now imagine a situation, you go to a bank, you want to withdraw your money. Your money, by the way. You go to the bank, you want to withdraw your money. And the bank says, sorry, I do not have cash. Should you accept it? Let me know. Right? Will you accept this argument of the bank? Right? Will you simply say, oh, you don't have money, I'll come back after 1 week? Do not accept it. Never accept this. Why? It is your money. Some of you are saying yes. No, my dear, never accept it. Right? It is your money. Demand it. And there are two students. It happens usually. No, my dear, it should not happen. If it is happening with you, then the bank is taking you on a ride. It should never happen. Trust me, it should never happen. I've worked as a manager of a bank. I know it should never happen in reality. So understand this. It's your money. You should be allowed to withdraw it. So argument is, what if the bank doesn't have cash then? Can that happen? Possibility is there or not? What if the bank doesn't have cash? Then, right, the RBI says, sell your government securities. You know you are running out of cash. Sell the government securities, collect the cash and ensure that people will be allowed to withdraw the money from your bank account. That is basically the importance of liquidity coverage ratio. Liquidity coverage ratio. This is the importance of liquidity coverage ratio. Done? Right, so these are certain important points regarding Basel III. Right, so we'll stop the discussion here. Tomorrow we'll start with the concept of non-performing asset. Now, if you have any kind of questions, please do let me know. Right, we'll have a look at the questions, then we'll wind up the discussion.